sessions. We do have 6 wonderful sessions that are put together today in 25-minute increments with hopefully 5-minute breaks in between. So we are just super excited and need to probably go ahead and get started. So with that, I'm going to say a quick blessing. Lord, I just thank you for our time today. Pray that you bless it. Lord, be with our team, be with our clients. Lord, be with our state, our country, and even the world right now as we just come into this holiday season. Lord, pray that you're with us through this pandemic that we've been facing and all the challenges it entails, as well as the opportunities. Help us ever have our minds on that which is hopeful and encouraging. In your name we pray, amen. Well, with that, thank you so much for being a part of our client event today. And we'll be recording this. So if you do have to hop off, this will be up hopefully by Friday afternoon. And with that, I'm going to go ahead and get us moving because of some time constraints to keep us on track. And anybody who knows me well knows that staying on track in time is not my strong suit. So any help I can get along the journey would be great. I want to introduce Larry Clume, senior consultant in our consulting group here at the firm. It's been leading us through the Triple P charge, and my goodness, what a journey it's been. And Paul Anglin, partner here at the firm, a tax director as well for us, and leading our tax group. And so we're going to get started with our first session, Triple P forgiveness and its tax consequences and planning. So Larry, Paul, let's take it away. Oh, absolutely need to make sure we have a Circular 230 disclosure here, which basically is to say, don't take any action until you actually discuss it with your CPA first. So, great. And
Morning,
Paul,
CJ.
I see you're unmuted. And Larry, there you are, sir. Thank you very much, gentlemen. Full speed ahead.
Well, good morning, everyone. Pleased to be here today to share some thoughts with you and what's going on in the world of PPP loans. It's been an interesting journey, that's for sure. Think back to those days in spring and in March when we had, in April, when we had the great Oklahoma land rush for everyone running to get their PPP loan, and all the banks were overwhelmed with applications and people were just so frustrated. So now we're at a point where nearly everyone's covered period, 24-week cover period, has now come to an end. Planning is pretty much over. The only thing that's really left for us to do with existing PPP loans is go ahead and file for forgiveness. But one of the questions that we've gotten a lot over the last few months is, when should I file? As you know, the SBA opened filing back on August 8th. Most banks were not accepting applications then. They didn't start accepting applications until September. There's still a couple of banks that are still not accepting applications. And then this great uncertainty about what's going on in Congress. Was there going to be some kind of a threshold of automatic forgiveness? There was a proposal over the summer months that all loans under $150,000 would be automatically forgiven. That became part of the stimulus bill, which of course really bogged down prior to the election, and it never got passed. So we think that the provision is really uncertain. Now that we've had the election, that there's probably greater uncertainty now than there was in October. So we're just not sure where that's going to go. So we've been recommending to all of our clients at this point, go ahead and get your application filed. We don't think that there's much to be gained by waiting. You do have up to 10 months after the end of your 24-week cover period. So for most clients, we saw the cover period end in late September, early October. So, a loan payment is not due for 10 months. That pushes you out to July or August of 2021. But we think there's really not much to be gained by waiting, and we're really encouraging everyone to go ahead and get that application submitted to the bank.
And it's been a process, right, Larry, of the banks kind of getting on board and getting ready to accept these applications. But for the most part, at this point, the banks have really gotten their programs together and have really their own approach on generally using a portal. Some not, just finished wrapping up a pretty big one that did not use a portal. Could you maybe just share a little bit about what we're expecting and seeing from the banks at this point? Because we've had the privilege of seeing lots and lots of banks in Nashville and nationally, and their approach to the loan forgiveness process.
Yeah, you're right, CJ. Nearly all banks now are using an online portal to accept the application, um, with a few exceptions. And the thing that has been interesting to me is that, of course, the application form itself is very standard, but the supporting documents that banks are requesting vary from bank to bank. Some banks are asking for an extensive amount of information and others not nearly as much. Once you get that application submitted, the bank has 60 days in which to review it and pass it on to the SBA. The banks are not taking anywhere near that long. It's typically a week to 2 weeks for the banks to review that application. Now, once you submit the application, the bank will typically give it to an analyst. Analyst will review it. If you're short on any documentation, they'll email you back and say, we need, this form 941 or this supporting documentation. Once the bank has finished that, they send it on to SBA. SBA has 90 days in which to review that. And for those that filed very early, back in October, it was taking quite a long time. SBA was not processing, but we are seeing SBA process now. And it's typically taking the SBA about 45 days from the time the bank submits the application to the SBA to make its determination. And the way SBA makes its determination, they won't send you information about it. What they're going to do is they're going to send a wire of money to your bank to pay that loan off. And typically your bank then will turn around and inform you that they've received the payoff and the loan has been paid off. But that's typically how the process is transpiring. There is one twist to this that's relatively new in about the last 2.5 weeks. The SBA put out for larger borrowers two questionnaires. It's Form 3509 and 3510 for nonprofit organizations. If your loan is greater than $2 million, there's a questionnaire. It's about 16 questions. And what they're really getting at is going back to that initial representation you made back in April about the need to have the loan. So if you are one of these larger borrowers, after you submit your application, you will get one of these forms to fill out. We do have them. I suggest you get them in advance because the SBA is asking they be returned within 10 business days. So better to be prepared and ready to submit this once you get it.
Yeah, that's a great point, Larry. If you are above the $2 million threshold, go ahead and start working on these. I just turned in the first one that I have had my hands on yesterday, and it's a pretty extensive process. And obviously in this scenario, there's a lot of money on the line if it's a greater than $2 million loan, because this is really kind of the background for what is the SBA is going to utilize, what I believe will be ultimately their audit process, but it's kind of the door into that. And it really has a lot of questions around operations and around liquidity. And those are really hard questions to answer for some of our clients based on some great years. But the reality of it is you've got to do all of this around the time and the circumstances at play at the time the application was made. And so these 3509s and 3510 is referenced on the bottom of the slide here. If you're over 2 million, it's important. Most of the loans are not over 2 million that we're working with, and most of the loans period within the program, the old 80-20 rule, right, Larry, are less than 2 million. So it doesn't apply to a lot, but when it does, you've got to be on top of it. Larry, do you mind just sharing a little bit about these different 3508s? Because our clients are going to fall in different categories based on a couple different scenarios.
Yeah, there are 3 forms on which you can file for your forgiveness. One of which is relatively new. The Form 3508S came out about a month ago. And this was the relief that everyone was looking for when that big proposal stalled in Congress. And it's a very simple form for those loans that are $50,000 or less. It's a one-pager. You're basically filling out information like your name and loan number, and then one numeric number, which is how much is your forgiveness amount. And then you initial some representations and sign. So that's one. And the nice thing about the 3508S is there's no testing for a decline in your full-time equivalent employees or the 25% wage reduction. The next form is the 3508EZ. which has been with us since the beginning back in June. And you're eligible to file this form if you meet a couple of safe harbors. One is that your business could not operate at the same level as you were on February 15th due to a COVID order. So if you think of businesses like a restaurant or a gym or a dentist office, commonly they're qualifying under that safe harbor. And then there's a safe harbor that says, I did not reduce the number of employees, the hours worked, or their pay rate from January 1st until the date I filed the application. So that's the other one. And then as indicated here in the graph, 3508 is the standard form, and that's for everybody else. Now you may think, well, some of these forms are pretty easy. The 3508S or the EZ is pretty easy. Where you're going to find you run into a bit of a challenge, and it's not so simple, is all the documentation that your bank is going to require you to submit. So even if you can file that form 3508EZ, which says, I have a $45,000 loan, my forgiveness amount's $45,000, the bank is still going to say, give me the payroll records to show me that you dispersed $45,000 of wages or rent or mortgage interest. So there's still some challenges there in terms of documenting what you're going to file.
Well, with Larry, with that, why don't we move to this next slide on the quick overview of the form itself, just because of the actual completion of this return. And it does feel like a tax return when you do this, especially as you work through it. You know, most people don't necessarily realize that a tax return gets consolidated into, 2 or 3 or 4 pages, but behind that are 50 or 100 or 200 or 300 that build into the form. And that really is the way that these applications work as well. There's a lot of information behind the scenes that gets consolidated into a couple of pages and a couple of schedules. But depending on which form it is, you still have a significant amount of work that has to transpire behind the scenes. And there's some gotchas in there too, aren't there, Larry?
There really are. For most of our clients, we're seeing that you're able to get full forgiveness simply using the wages that you've paid during the 24-week period, or even a more shorter period. The reason for that is the original loan was based upon 2.5 months of your 2019 wages, and the covered period back in June was extended to 24 weeks. So you're comparing 24 weeks of wages to 11 weeks of wages when you got the loan. But there's some caveats in there. As CJ mentioned, you still have to prepare some schedules because there are some limitations. If you've got an employee who's earning at a rate of greater than $100,000 a year for the 24-week covered period, you cannot include more than $46,154. That's $100,000 over a 24-week period. There are also some restrictions imposed upon owner employees. So these would be any employee who's also a stockholder that owns 5% or more of the company. Their compensation is going to be limited to the least of $20,833 or 2.5 months of their 2019 wages. There's also going to be limitations imposed on partners and sole proprietors. Their includable compensation is going to be limited to $20,833, or again, 2.5 months of their 2019 self-employment income. So you can't just take your wages and throw it on the application and say, we're done. You do have to look through and see whether these limitations apply.
That's right, Larry. And when they do apply, generally speaking, because of the extension of the cover period to 24 weeks, which was really a very nice adjustment for PPP borrowers, you're still going to get there for the most part. Now, there are some other issues where there's some double dipping around grants and things like that that can create some issues or really significant reductions. But for the most part, with the 24-week cover period, at this point, Larry, we're seeing 100% forgiveness eligibility, at least for almost everybody.
Yeah, it's pretty rare. It's pretty rare when we run into a client that's not getting 100% forgiveness, and almost always simply using their wages. Now, in addition to wages, you're still permitted to use rent that you've paid on your facilities, mortgage interest, which would really means interest on secured loans that were outstanding on February 15th, and your utilities. So if for some reason you did have a decline in staff, you can't get there with your wages, you can use these other items. The only caveat there is your payroll costs have to be at least 60% of the funds that the PPP loan that you received in order to get full forgiveness.
That's right, Larry. And as you said earlier, I think it's a great point, just from a, kind of quote pro tip, if you will, is just use those wages, because it's going to be a lot easier to substantiate those than to go in and pull all the supporting documentations the banks are required, canceled checks, bank statements, et cetera, around these other covered expenses that are non-payroll costs. And so I think avoiding those generally, if we can, is the right approach. And then also making sure, and this is just, one last point here, and I don't think this is in another slide. If it is, forgive me. But one of the things that's really important is to get the right covered period and get the right amount of self-employed earnings for our pass-through entities and our Schedule Cs, because of this next issue that we're going to talk about around non-deductibility. So kind of in that vein, Larry, kind of talk to us a little bit about or I don't know if Paul, you're going to cover this one, but let's talk about the other side of the coin and then integrate in these self-employment discussions, because there was a very nice silver lining in this cloud of forgiveness that transpired for these loans and it not being taxable. But there's a little bit of a rain cloud that's on the horizon, because the other side of that coin is that creates a pretty big issue for us from an income tax standpoint as of today. Correct, Larry?
Yeah, this is one where we've been kind of surprised and then surprised again. So the original CARES Act, when it was passed by Congress back in March, provided that the forgiveness of your PPP loan was not going to be considered income. Generally, when a loan is forgiven, it's income to you, but Congress said, no, we're not going to tax you on the forgiveness of the PPP loan. About 2 months later, the IRS came out with a notice and said, well, that's all fine and dandy, but we don't have to include your loan forgiveness in income, but the expenses that you paid to get the forgiveness are not going to be deductible. So in most situations, it's, brings you right back to square one. It's basically that loan forgiveness is taxable. So that was something interesting. At the time, some members of Congress came out and said, that's not what we intended. We're going to fix this. And we'll talk about that a little bit more in the next session. But as the situation stands right now, the expenses that you put on your application to support your forgiveness are not going to be deductible in 2020. And we got some guidance on that as well about 2 weeks ago, when we mentioned here on the slide that the IRS issued Revenue Ruling 2027. There was a lot of debate for several months about, well, when are these expenses disallowable? If I don't file my PPP forgiveness application until 2021, can I claim those expenses in 20 and then recapture them and report them in income in 2021? And the IRS came out and said, no, that doesn't work. If at the time you pay the expenses, you have reasonable anticipation that you're going to get forgiveness, these expenses are not allowable as a deduction in the year that you pay or accrue them. So it's a 2020 disallowance of these expenses. One issue that remains, though, is for our self-employed or partner borrowers, or partnership borrowers, the self-employment income that you're using to obtain forgiveness is never deductible. So what we're encouraging our clients to do is limit the use of your deductible expenses in getting your forgiveness and maximize the use of your self-employment or your partnership self-employment income. Say, by way of example, let's assume that you have a $100,000 loan and you have $20,000 of self-employment income and $130,000 of forgivable expenses like wages. How do you report that on your application? If you're to report all $150,000, how would the IRS treat this? We don't have any guidance on that at this point. So what we're suggesting to our clients is, hey, even though you have $150,000 in forgivable expenses, including your self-employment income, just report $100,000, $20,000 of your self-employment income, and only $80,000 of your other costs, because we want the full $20,000 of self-employment income to be non-taxable and only have $80,000 of otherwise deductible expenses disallowed. So that's a really important thing that many borrowers are missing that.
It is, Larry. That's a great point. And that's one of the reasons why it's so important to make sure that these forms are kind of completed correctly. We could inadvertently leave money on the table, candidly, especially around this deductibility issue around the associated expenses. Now, there's been a lot of conversations by Congress to basically allow for these expenses to still be deductible despite the current application of the overarching income tax code to expenses that are associated with tax-free income. So we'll have to see if that transpires. Initially, Senator Grassley was very vocal to say this is not what we intended whatsoever. Secretary Mnuchin obviously signed off on this IRS treatment and has been eerily silent around this throughout the entire process. And although it has found its way, and we're going to talk about this a little bit later in a couple of different acts, nothing has transpired around this issue. So let's just keep hoping that maybe these expenses do become deductible again. But as of right now, the law as it stands is that they are not deductible, as well as they are not deductible in the year incurred, which is 2020. So a big planning point. The best way to really kind of keep up with that right now is if you have that loan still on your books as a liability, go ahead and debit that liability and credit income. Go ahead and pull it out of liability and put it into income. And that's going to give you a better idea of what the bottom line is looking like if you haven't already done that. So make sure you do that. And then all of a sudden what you're going to see if that's still sitting, and it is with many of our clients on the balance sheet still. So when you take that $500,000 PPP loan and you pull it out of income or pull it off the balance sheet and stick it in income, that bottom line shoots right up, which kind of gets us into what our next session will be about, which is end of year planning. We've got two more slides here that I want to go through relatively quickly. And one's a little bit of a surprise. Sorry, Larry and Paul, but I threw this one in here just so people kind of understand. There is at times non-conformity between states and federal taxation laws. And you have that with some of the CARES Acts. And so you got to be careful around particularly this PPP at certain states, Maine, Massachusetts do not conform, and then you've got some other states as well that have some special implications. And this is because a lot of states do not follow the income tax code as in place at the time, and so it may be tagged to a prior version of the code. And so you have some issues that come around this. Just because it's one way for the Fed doesn't necessarily mean that PPP is going to be treated the same way for the applicable state of filing. And then lastly, I want us just to kind of cover this point here, because one of the things that's been discussed out there is, oh my goodness, what if, go ahead and advance the slide there if you don't mind. Thank you very much. What happens is, and now I've received this PPP loan, I used the money to pay my people, I didn't really need them, et cetera. Come back to our consulting throughout the course of this year around taking care of the house. Hopefully you've seen that in our blueprints that are in some of our previous presentations, which are all available online through the website under relief. But the good news is here, this is kind of a net zero example. I'll let either Paul or Larry let you guys kind of talk through this right before we wrap up, and maybe just explain how this kind of flows.
Sure. Thanks, CJ. This has been an interesting discussion we've had this year as, the PPP loan and wow, it's income. This was, as Larry mentioned, it was such a surprise to people that, wow, I'm getting this loan, I'm getting free money income, but why is it income? And we were just thinking that maybe this is a great example just to kind of think through the intent of the loan. If we think back in March when all these non-essential businesses were closing, you didn't have income coming in and you were laying off employees. So really you had no income, you had no expenses, as these first two bullet points show here. So if I'm a non-essential business and I'm closed, obviously I have no revenue coming in. And if I have no revenue, I've probably furloughed my payroll and my staff, my employees, so I have no payroll expense. So I would have zero net income if it weren't for the PPP loan. But because of this PPP program, I go out and get a $100,000 loan, and that's great. and I want to use that to pay my employees. So now I have $100,000 of payroll expense that I would have not incurred otherwise. But I'm also going to have a disallowance of those payroll expenses because of the forgiveness. So I'm really back at a net zero perspective. So when you think of it in this this terminology, it feels more like a wash, even though it seems to most taxpayers that this is an income pickup. And it is, because you continue, for a lot of taxpayers, continue to pay their employees during that time. They continue to operate and generate income. As CJ mentioned, going back to the house slide that we've talked about several times this year, if it makes sense to keep those employees, they're producing, you were going to pay them. So now at the end of the day, we have this payroll loan forgiveness. It's free money to taxpayers, so it's going to feel like income at the end of the day.
That's right, Paul. Thank you so much. And Larry and Paul, just what a great leadership you have provided through this time. Larry, I think you're on the hook for most of the morning sessions. So we're just getting warmed up here. We're going to go ahead and move into our next piece here. But thank you very much, Paul, for your insight. And it's you two guys still on the table here as we move into end of the year in tax planning. And what a great segue, given the reality that for a lot of our clients, because of the PPP loan, if they were able to get through at the time when PPP was coming out, my goodness, looking back on that, it felt like, I'm not going to say the world was ending by any means, but it was intense, especially for us accountants, as we processed these all these different bills that started hitting between the FFCRA, which we'll talk about a little bit more later today, and then, of course, the CARES Act, and then all the different pieces that came on top of that. Of course, all the PPP loan applications and the business closures, which were really a big deal. And we're starting to see that pick back up again now. So at the time, it was so intense, and never, ever would we have thought that we'd be coming to the end of the year and having to do some pretty intentional planning and having a lot of discussions with clients who have had just some of the most amazing years because of the windfall of the PPP monies. And so with that, we're moving into our year-end planning with a special focus on entities. Of course, you've got flow-throughs on the Schedule C that would come into place here as well. So with that, let's advance the slide here. I think that every single one of these will have the Circular 230 disclosure because they're standalone units. Again, make sure, do not rely on this as tax advice, and have a conversation with us prior to taking action. So with that, next slide. Thank you very much. And so on our entity planning, we really want to just make sure everybody has a thorough understanding that as of today, the PPP loan associated expenses are non-deductible, which basically means it's income for you. And so make sure to get that off the balance sheet. Go ahead and be planning for the effect on the bottom line. Maybe Congress will act. We'll see about that. We'll talk a little bit more about that in the session later today. We want to talk about these tax planning opportunities that need to be undertaken before the end of the year on the 31st this month, and talk about both how to handle a banner year and a bad year. So with that, let's advance. Take it away, guys.
Thank you, CJ. So let's kind of step back like we did for the PPP loan, thinking about the year. We got to go back a couple of years and think about the Tax Cut and Jobs Act that was passed. It feels like it was just yesterday, but it's been a couple of years now. And what an amazing act that was. The most significant legislation, tax legislation we've seen in a long time. For some people, their lifetime. For some of our younger associates, definitely a big change in tax law. And one of the biggest things that came out of that was the favorable tax rates. For those that have C corporations, the 21% tax rate on earnings. Think about that, going from 34 or 35% down to 21, which is a significant cut. Just never had seen the likes of that before in the corporate world. And then on the small business side, the qualified business income, the 199A deduction, the individual rates obviously went down a bit across the board, but you had this qualified business income deduction that, depending on your business and situation and circumstances, obviously we'd like to talk about the levers around that, generates a 20% deduction. So that could take your 37% rate down closer in line to the 21% rate of what the corporate rate would be, depending on where you fall in those progressive brackets. The cash basis rules were very much given some generous limits there, up to $25 million for receipts over a 3-year period. If you had below that, you can use a cash basis. So a significant increase from the old limits. A lot more taxpayers are eligible for those cash basis tax filings. What an incredible way to defer revenue by being on the cash basis method. Depreciation finally got some more clarity around the bonus depreciation, at least as far as the 100% depreciation is in the law for several more years. That will start to phase out and reduce down to zero, barring any other type of legislation. Also very generous 179 rules. The limitation is now up to $1 million through the TCJA, but that's also been adjusted for inflation adjustments. So that's up above $1 million right now. So great opportunities to take advantage of currently expensing equipment or other purchases there. The QIP, the Qualified Improvement Property. This is one that we all like to smile about, that knows much about this, that the TCJA thought they were fixing a problem or trying to simplify an area of qualified improvement property of 3 or 4 different descriptions of QIP and made it one area, but they forgot to say it was bonus eligible. So luckily the CARES Act, when it passed back in March, made this QIP property now eligible for bonus, 100% bonus. So the opportunity there is that we can take a current deduction by filing an accounting method change to claim all that unused depreciation in the current year, which might be a great opportunity to reduce income in the current year. So a lot of different changes coming from the TCJA that has been around, that we've grown really accustomed to over the last couple of years. So with that, obviously we're now past an election. Obviously things change with elections, as we know. So obviously still a little bit more to know. We have an election coming up in January. 2 Senate races will be decided then. If it goes both Republican or both Democrats, obviously this might be easier or harder to implement based on that outcome. But President-elect Biden has already been discussing some of his proposed tax policy. So it might be a good idea to just discuss the highlights of those before we kind of dig into our further tax planning session. So we just talked about the 21% rate from the TCJA, but that corporate rate is looking to go up to 28%. Several business tax changes out there, incentives. These are really probably less for our client base, thinking about 15% minimum tax on $100 million of income. But changes nonetheless. I think we get the idea from his proposals that there will be changes. There will be opportunities to look for increases in federal tax collections. This third point here, I think, does have a significant impact on our client base, is the potential elimination of the 1031 like-kind exchange deferral. This is something that our clients have enjoyed for years. The TCJA did make a change around like-kind exchanges that only real estate after that is now eligible for the deferral. But this is on the table as something that would go away. I would suspect that there will be a lot of lobbying around this area that I think even before my time, CJ, I'm thinking 1031 has been around forever. So I really find it difficult that this would go away, but it would be a easy way to potentially increase income. And then lastly,
and I didn't think that we would see. Oh, sorry about that, Paul. In Tax Cuts and Jobs Act, and all of our clients hopefully have been a part of. Had a great presentation that we did back at the Embassy Suites, and there's been some recordings out there of it. Like-kind exchanges used to exist, though, in all sorts of other areas, right, Paul? We did it for construction equipment and a variety of other factors. But it's already been reduced down to just real estate. It was one of those lasers, a revenue raiser in the Tax Cuts and Jobs Act, because it was passed under reconciliation. And so stranger things have happened. We'll have to see what happens. Obviously, the Georgia runoff's a big piece of this whole conversation. But
Absolutely. The last one there is the GILTI. I won't spend time on that as I don't think it applies to many of our clients here, but I think it's relevant though that you can see they are looking for opportunities to raise income both on domestic and foreign operations. So keep that in mind. From the individual side, it looks like the rates are probably going back to where they were prior to the TCJA. It seems to me, though, if I remember the $400,000 top rate, that's probably a lower threshold than it was. But again, the government's looking to raise money. We've all kind of been talking, just kind of casually thinking all these PPP loans and all the trillions of dollars of legislation that's passed, it's going to have to be paid for eventually. Along with whatever other policies that President-elect Biden would want to enact. So they are looking for opportunities to raise money. I think the key point here is, as I mentioned, the 199A deduction, the QBI deduction, that is looking to be phased out. This is one to me, I think it was such a gift to small business owners that to me, I feel like it's going to be a big push to eliminate that or phase it out. But time will tell. CJ, any thoughts you have specifically on that one?
I'm so sorry, Paul. Repeat that one time. I was answering a chat over here.
Sorry, just talking about the QBI phase out deduction. Any thoughts
on
that one?
Yeah, I mean, I don't think we're going to see any changes around that other than, of course, the reality that, Biden would take it completely away. And so the phase out area zone, if you're in the midst of that zone and you're an SSTB, you've gotten above that, then obviously that plays into some of the planning that we're going to talk about here, particularly in which I can't believe I'm going to say this, but maybe we accelerate income conversation, right, Paul?
Yes, absolutely. Thank you, CJ. But yeah, big change there on the elimination potentially of the 199 deduction. Capital gains, here's another one for income over $1 million. Think about having ordinary tax rates applied to capital gains. Huge change, huge deviation from prior tax law. But again, as potential revenues are being sought, I think this one is probably directed at hedge funds, and carried interest would be probably where I would see that one being most likely applied. But so far, we haven't heard much of a deviation in capital gains.
Yeah, the big one there, Paul, and hopefully from a client perspective, at least, that there's not going to be a complete run that's going to result, and maybe even selfishly, I don't want to learn a whole new tax act. We've been learning a lot of tax acts the last couple of years. Now that we're starting to get TCJA underneath our belts, all of a sudden that's going to go out and get replaced with a new one. It could be a really interesting year. So maybe out of some selfishness there, but the reality is for our clients, this could be a really big deal, especially when you sell a business, right? And because the general rule is they're talking about taking away the capital gains rate for anyone over $1 million of AGI. And so what that would mean is if you have one of these, hallmark type experiences where you sell your business for 10 million, and there's been no conversations about carving out small businesses or things like that I'm aware of. I think there's been a conversation, but it fell on deaf ears. I mean, that would be a really big deal if all of a sudden you sell your company for $10 million and instead of paying, 23.8%, you're paying 40%.
40%.
That's a big deal.
That is huge. That is huge.
Mm-hmm.
Let's keep our fingers crossed and hope that one doesn't come in. But obviously, all of this is subjective at this point, and we'll see what the future holds.
Yeah. Thank goodness for installment sales, right, Paul?
Hopefully that would work, CJ. Some other credits and deductions potentially being changed. Obviously, for the lower income taxpayers, more credits given there. One of the big things here that I'd point out is the $10,000 cap on state taxes has been a thorn in the flesh for many legislators, especially from highly taxed states that have seen that limit, the $10,000 limit. So I would not be surprised to see that one go away. That one's been yelled about ever since the TCJA was passed. And then the 28%.
That one's on the chopping block for sure.
Absolutely. Yeah. And then the 28% cap on itemized deductions. Kind of feels like a little bit of the old limitation, the 80% limitation that used to be around. But definitely some changes there. And then finally, there are another significant change, payroll tax for income over $400,000. So think about right now, the Social Security, the 6.2% tops out at the limit of about $130,000. So you would have this nice little donut hole up to $400,000, and then you would start back on the 6.2%. So that could be a terrible change for many taxpayers.
Yeah, that would be a really, really big one, to say the least.
Definitely.
Now, something needs to be done about Social Security. But if that's it, get ready. That would be a really big deal.
Absolutely. Absolutely. So with those thoughts in mind, let's think about, again, where are we at? And, thinking for just from a tax perspective, what would be a great time to be a business owner for the next 4 years? A lot of changes are coming. We don't know exactly what will be down the road, but changes are coming. And as we think about the political background, as we just talked about, the PPP loans and the forgiveness that Larry has just talked about, it's been a very challenging year for many taxpayers. Some have had banner years, some have had bad years. COVID, it's still rampant. The next few months are very uncertain. So there's just still a lot of uncertainty out there. As we think about our tax planning and objectives, the biggest point that I would make is you have to make sure that you're not doing tax only decisions. You need to look at the big picture. Where are your cash flows? Do you think that you're going to be potentially subject to another shutdown in the next few months? Do you need retained cash? And I say that because a lot of our tax deductions are based upon cash outlays, as we'll talk about some of our tax planning strategies. But to get deductions, generally it takes a cash outlay to achieve those. Generally speaking, and we'll talk a little bit about some maybe exceptions there, but thinking if you feel like your operations are going to be again slowed down or shut down, tax planning is great. Thinking with the PPP forgiveness, maybe you're sitting there with $100,000 of taxable income and you have $100,000 of cash. You may not want to spend $100,000 of cash on buying equipment at this point because you may want to hang on to that. So I just say all this as we're thinking about tax planning. Keep that in mind. There's other business objectives. Tax is obviously one of them. It's very important, but don't let that wag the dog, as we like to say.
That's right, Paul. And kind of just as backdrop, and I'm going to kind of fly us through the next two slides here, if that's okay, Paul, just to make sure we get to some of these strategies. But it is a really good time to be a business owner in 2020. I'm just going to say that right now, because at the end of the day, between the Tax Cuts and Jobs Act, lowest income tax brackets, really great wide graduated rates that are really attractive, QBI, which is just cannot be overstated. Hey, here's an opportunity to only pay tax on 80% of your income if structured correctly for the flow-through entities, 21% for C corporations. We know beyond a shadow of a doubt that 2020 is a great time to be a business owner. You layer a lot of income on top of that, and all of a sudden we find ourselves asking questions. Ben, if you don't mind, advance to the next slide. You layer the income of the PPP on top of it. And we went into this in our previous presentation, but just so it's very clear, even though the PPP income is non-taxable, it effectively is taxable because the expenses as of today are non-deductible. And when is that going to be? As we stated earlier in the previous session, Revenue Rule 20-27, it's right now, it's 2020. And so you have these things that have been built into it. Ben, if you don't mind, advance to the next slide, where you can potentially have a really big year. And with some of the different decoupling with NOL rules and Section 163J and 461 as well, you're in a spot where potentially you can have a lot of income that's coming in this year. And so normally the knee-jerk reaction, if you don't mind, Ben, go to the next slide, and then we're going to get going, is, oh my goodness, I've got a lot of income, and I need to do some serious advanced planning and be able to pull this down as much as possible. But because of all the backdrop that Paul did a great job explaining earlier with the potential for what's going to transpire with the Biden tax reform. And there is some belief that some of these things actually might get through, like that we are actually going to work together between Republicans and Democrats to be able to pass some legislation around some of these Biden tax plans, candidly as bartering points around other issues. And so don't be surprised if even if Georgia does go to the Republicans and you have separation of powers there that are transpiring, where it's not a blue run across both Congress, both houses of Congress and the presidency. There still might be some things that come in. And so with that, let's talk about if we're seeing just this banner year, that's all backdrop. And then we're going to talk a little bit about if we have a bummer year. But if we've had a banner year, it's a complicated time to think about what to do. I'll let you guys take it from there.
I always say the best tax deduction to get is one where you can pay yourself. And I think CJ would agree that. And our very first bullet point here is retirement planning. And what a great way to fund your retirement or your employees' retirements. You defer that income down, but you retain control of that income. So if you've had a banner year, this would be the first area I would say that you need to look at as far as, can we make some additional contributions to retirement plan funding? The nice thing about retirement planning funding too, is I just mentioned, generally you need a cash payment to receive a cash deduction. And that is true here in this case, but a lot of retirement plans, the funding does not have to happen until you file your tax return. So you do have some opportunity for timing of that payment, but yet you can get a 2020 deduction for that payment. And the trifecta, as we mentioned here, thinking between your IRA, 401ks, profit sharing plans, even a cash balanced pension plan, the potential for deferring funds can be pretty incredible. So if you've never really explored this area as the deductions that are available, tune in at 11:30. I'll give a little shameless preview for upcoming presentation, but we'll be going through more of the retirement planning areas, but definitely the first area you should look at is retirement planning. So working across the slide here, delaying income, as we mentioned, the cash basis method of accounting is really a good way to manage your income and your taxable income for the year. And really, the point here is if you have AR out there, think about your GAAP basis financials. You've recorded income and set up your AR. If you're on a cash basis of accounting for that income is not income to you until you actually receive the cash. So maybe you want to be calling some of your people up and saying, hey, I really want to get paid, but please don't pay me until January 1st. And hang on to that check. So if you don't receive that check until next year, you've effectively deferred your income until the next year. But consideration needs to be thought around this, as we just talked about. Where do you think the political landscape's going to go? Where are you on your graduated rates? Maybe you don't want to delay. Maybe there's some reasons to say, no, I would really like to take that income now. So maybe I need to be calling up some of my AR accounts and saying, hey, make sure you pay me before the end of the year so I can go ahead and recognize that. Really, if you think rates are going to skyrocket next year, maybe this is the time to go ahead and collect and get your AR down. So again, as I say, don't let the tax benefits necessarily drive all your decisions. In this case, that would be a similar tax benefit. But, from the same point, if you think the economy and the closures with COVID are about to hit, maybe you want to really focus on collecting AR, especially if you think those vendors or customers might be in trouble themselves. Cash, I would think cash is better than no cash with a bad debt deduction down the road. So just some thoughts around that. And accelerated expenses, same thing on the cash basis conversation. If you have payables out there, you can pay those payables. So if you couple these two, if you're taking your cash payments for income into next year, but you're paying down your payables this year, you're going to get the double benefit of delaying income and then accelerating those expenses. So you can really reduce your taxable income just from the cash basis approach. Some other ways to accelerate expenses. If you have bought real estate or have made improvements, cost segregation studies can be a great way to carve out some of the shorter lived property, get the bonus or 179 deductions on that and take a current deduction on that. So that's a great way to reduce your taxable income. As we mentioned, the 100%.
And Paul,
sure.
Just to speak to that just for a second, I think it's important just to layer in, even though we had a great big huge act in the Tax Cuts and Jobs Act, we had a really big one back in 1986 as well, the Tax Reform Act, that talked about passive versus active income. And so you can't just go out there as a, say you're an accountant by day and a real estate person by night, and that by night is less than 500 hours, then you can't just go out and buy a piece of real estate and then turn around and do a cost segregation study on it and utilize that to decrease your income. Now, on the other hand, if you go out and buy a piece of real estate, because that's passive, just so it's very clear, by definition, it'd be passive, so it cannot offset active, in other words, business income. So on the other hand, if it is utilized in your business in the appropriate structure, then it would not be considered passive. So for instance, you're an accountant by day and you buy a building for yourself for the use of your accounting, and then you turn around and do a cost segregation study on that. That can be utilized as long as the ownership structure is correct in the same space. It doesn't trigger those passive rules. So just want to kind of clarify that for everybody. But some really good news on qualified improvement property, right, Paul? Which we call QIP.
Absolutely. Currently eligible for the 100% bonus depreciation rules. So if you went out and bought a property and then made improvements to that property, all of that qualified improvement property could be written off in the current year. Just kind of a thinking about cash flows and tax deductions. This is one of those areas, thinking about depreciation deductions. Again, going back to the example, if you have $100,000 of taxable income and you need $100,000 of deduction, financing your equipment purchase could be an option to do that, right? So you get the current year deduction on your equipment. Interest rates are low, so you finance that over the 5-year period, 7-year period, so you can effectively get a tax deduction now and have the cash outlay over the next several years. So, that might be a good strategy anyway if you're looking to conserve cash, but want that tax deduction. And then as the economy or our status is better known as the vaccines and whatnot come out, maybe 6 months from now, you see that your cash position is going to be fine, you can pay that off. So just
That's
another
right.
thought about as far as the depreciation. And lastly on this slide,
money right now is about as, I'm sorry about that, Paul. Money right now is about as cheap as it's ever been, and at least in my career. And so by using some of that healthy, appropriate leverage to finance, if you've had this banner year, particularly when it comes to real estate, and it may even be that you need to do that regardless because of the income tax consequences, which gets into this next category of saying, you know what, it might make sense to actually pay the tax, right, Paul?
Absolutely. As we said, cash is king right now for many taxpayers. So that $100,000, I might feel more comfortable paying the $37,000 of tax if I'm at the highest brackets, and knowing that I had that $63,000 in my pocket for the unknowns that might be happening for the next few months. So that's always an option.
Yeah.
Like I said, don't let the tax answer always drive your business answers, because you got to stay in business. You have to have inventory. You have to be able to service your customers. So make sure you're looking at all aspects.
That's right, Paul. And and not only is it from a operations and a business and a cash conservation perspective, but also because even at that 30% bracket, which may go up to 39.6, not highly likely at this point, but what we do know for sure is that if you're a QBI eligible individual, business, I should say, that flows through to the individual, you're only paying tax on 80% of that as well. And so at some point, it's okay to get some tax basis in this, unless you can see a really clear path to continue to defer forever. There might be an opportunity to go ahead and just pay the tax this year, depending on where you're headed next year. If all of a sudden, you're thinking next year's going to be a really down year, it's very important to build into all this analysis the effects of graduated rates. But if a lot of our clients are always going to be in the highest tax bracket, and so you got to bake that analysis in. There's not a hard and fast answer to it, but there are some great levers that we can pull between retirement planning. Obviously, if you're accrual basis and $25 million or less in income, flipping to a cash basis could make a whole lot of sense. That's eligible under the Tax Cuts and Jobs Act, even though beforehand, if you triggered went over 10 million, you were forced to move to accrual. So you've got that to build in. The benefit of potentially accelerating depreciation and or just buying good old-fashioned assets if you're in this banner year and you don't feel like it's going to be, hey, I'm in the highest income tax, I'm going to make $1 million taxable income this year, but usually I'm at 500,000. Well, this is a year you would want to go ahead and hit those traditional those traditional strategies that are going to bring down that income back down to the lower brackets. And so I think that is important to kind of bake in, but not everybody's having a banner year. Some folks are having bad years. So with that, let's move to this last slide here and talk about, some strategies that maybe we have in what I would refer to. I don't know if my brother, older brother, Trace, attorney here in Townsville, I say, well, that would be a bummer year, CJ. And so if we're having a bummer year, some other things that we really want to bring into thought.
Absolutely, CJ. So a lot of these are just kind of the opposite of what we just talked about. But from a retirement planning strategy, keep in mind that the CARES Act did have some benefits to allow taxpayers to take $100,000 out of their retirement plans without the penalty. And if you're having a bad year, the tax on that, if you're having losses, that would cover that position. So that might be the time to think about, if you have been affected by the COVID situations, that take out that money. It might be a good area time to do that. Accelerating income. Think about Roth conversions. Again, thinking from a retirement planning perspective, but if you have traditional IRAs sitting out there and you have losses, maybe this is the time to convert. You would have the losses to cover that potential income. And as we just kind of talked about with the cash basis of accounting, now's the time perhaps to be calling up your customers and saying, hey, I need that AR payment prior to the end of the year, and accelerate that income. So another aspect of where you can accelerate. Delaying expenses, as we mentioned too. Don't make those cash payments until next year. If you already have a loss, defer making those payments until January 1st, and then you can get those deductions next year. The depreciation. You needed to buy some equipment, but maybe this is the time to opt out of bonus depreciation or not take 179 on that and just let it run its normal depreciable life. So there's some definite flexibility there. And then lastly, maybe most important for taxpayers that have incurred losses, the NOL rules were, again, given more generous carryback periods with the CARES Act. The TCJA had limited NOL carrybacks to 0, and you could only carry those forward, but the CARES Act reinstated the 5-year carryback. So if you have higher tax years, definitely the opportunity to go back and claim. Maybe even if it's not a higher tax year, if you can go back and get a tax refund and recover cash, definitely that might be the thing to do. The excess business loss rules have also been have been suspended. That I don't think those that really apply to many of our base here, but just to refresh our memory, if you had a loss of over $500,000 for a married filing joint return, you could only take the loss up to $500,000. So in this year of uncertainty and challenges, if you've had a really bad year, a really bummer year, and your loss is over that, potentially you would be able to use that loss. But as the last point here does state, you got to really think about what these losses are. As CJ just mentioned on the property example, it depends on how that property is, what your investment is, how you're involved in that investment, whether you have basis, at risk, passive activity losses, just all the gamut of rules that potentially could limit those losses on your tax return. So you have to keep all this in mind and make sure you're considering everything. So the last point there I would say is definitely talk with your CPA to go over your particular situation and find out what's the best result for you.
That's right, Paul. And don't just think because you have a loss, you get to take it. It's really important to understand it's complicated. Coming back to our previous point, talk to your CPA. Let us run the projections. We've got some great software and tools out there. We're tracking generally for all of our clients, your basis, your at risk, all these different requirements. And so, lean on your CPA around this discussion, particularly if you're having the bummer year. But just to stress one last concept here that's on here. If you have had that super bummer year and you have this opportunity to take advantage of graduated rates, you're always in the highest income tax bracket. You're always over $600,000 in taxable income. You have this year now where you're going to be at, $150,000 of income. Then you pull off your itemized and other deductions, et cetera, AGI deductions, and you're going to be way down there in the very bottom brackets. Well, this is a great year to look at some of those IRAs and convert them to Roths. And because of the Secure Act that came out at the end of 2019, all of a sudden Roth IRAs, they've always been great. And we've always been wanting to try and get money into that sort of category of qualified income. But now they're better than ever because of the prohibition of the stretch rules, or the repeal of the stretch rules that allows you to pick that income up in the next generation over 10 years. And so now a Roth and the ability to convert used to have AGI limits around conversion that doesn't apply anymore. you can convert as much of this as a Roth as you want to. And so if you have an IRA out there, you're having a bummer year, and you're going to be in the highest income tax bracket in the past, you're going to be in it in the future. Well, take advantage of that to convert several $100,000 into a Roth. Take advantage of those rate differentials, and then get all that tax-free growth and then the tax-free distributions on the back end. So we could probably spend literally 2 or 3 hours talking about, maybe even all day, to be quite honest with you, on tax strategies for both bummer years and for banner years. But that's why we need to make sure we're having a conversation with your CPA. So with that, we need to get to the next session. But Paul, I think you're going to be off duty after this one, isn't that right? So thank you so much for leaning in a little bit here, brother, and helping bring some of your expertise. But some significant planning opportunities that need to be undertaken when it comes to tax. Please reach out to your CPA. We got an amazing tax department. Let's run some projections. Let's figure out where we're at and what we can do over the next 30 days. Come up with some ideas that are going to be unique to your situation. So thank you, Paul. And thank you, Larry. Larry, you're not off the hook yet, though, are you, sir?
I'm still with you, CJ.
Well, with that, we're going to talk about congressional relief. And I'll tell you what, we even have something interesting come out tomorrow. So we were updating this last night late, and so some good discussions. We're going to, Karen, I think you're on here. Hopefully you're unmuted and can chime in. Are you there, Karen?
I think I'm here.
There you are. Wonderful. And so Karen, audit partner with the firm, and leads our Goodlettsville operations. Welcome. Thanks for coming to the party today. And Larry, not off yet. So with that, we're going to go on forward here. You've heard this once before. Don't rely on this for tax advice. Please have a specific discussion with your CPA. It's the legal disclosure. Next, here's what we're going to so never mind. We're going straight to the recap. Take it away, guys.
Okay, well, I think I start. Good morning, everybody. What a difference a year makes, or 11 months. And we've been saying, if you've been joining us as we've had the webinars, that things can change. They can change quickly, or it can take a long time for them to change. And that's exactly what we're going to see today, as we kind of walk through a recap of what has passed, what could be coming, and just some additional PPP provisions that Larry's going to cover towards the end of this session. So just a whirlwind of things that actually have passed legislation and we've been implementing and using over the last 10 months or so. So at the very beginning, back in March, the first relief bills that came out were the Families First Coronavirus Relief Act. And we did a series of webinars on those. If you've not watched those, you may want to go back and take a look at those. They're available on our website. Still, two provisions of that act, the Emergency Paid Sick Leave and the Emergency Family Medical Leave Expansion Act, are still in effect, at least through December 31st at this point. And there's really two strategies on that that you'll hear if you've been with us. The post and don't promote, or the post and promote. And with the resurgence of the cases nationally, I think we've probably seen some resurgence of conversation about this in the last few weeks. So just as a quick reminder, that act provided for some pay to be reimbursed by the federal government to employers if an employee met one of 6 conditions, and the amounts of that pay depended upon the conditions. Generally speaking, it was either you yourself were sick, you were caring for someone who was sick, or you had a school-age child under 14, I believe it was, that was at home. And so many Americans fell into those categories. The Emergency Paid Sick Leave was up to 10 days, and the Expanded Medical Leave Act up to 50 days, with amounts ranging from $500 up to $511 a day for the sick leave, to up to $200 a day for the Family Medical Leave Act. So unless we want to hit anything else on that, I'm going to move on from there. The second big act, again, the Coronavirus Aid, Relief, and Economic Stability Act, the CARES Act, was the second big piece of legislation back in the spring. And really the 3 biggest provisions of that that have been going on, PPP, the Paycheck Protection Program, which we've talked about and will continue to talk about. Few statistics on that. That bill authorized $659 billion in loan relief under that program, and actually $525 billion was expended or funded before the sunset of that. Interestingly, the average loan size was only about 101,000. So we were talking about those large loans over $2 billion today, but the average loan size was only $101,000. So really just widespread participation in that, to say the least. And then the unemployment insurance.
And Karen?
Yeah.
Just to add some thoughts around that, I don't think a lot of folks that are not business owners have appreciated the impact of those PPP dollars. I mean, that was, there was a recent article that just came out that was actually stressing that the reason why we're sitting where we are through this pandemic is the PPP funds primarily, because it really did save small businesses.
Absolutely.
And I mean, that has been our experience. I mean, those PPP funds, if it had not been for those transpiring in April at the beginning of the pandemic, I mean, we were already at 20% unemployment. Imagine, I mean, it would have been significant.
Catastrophic, really, if you think about it. And, $659 billion. It's interesting to me that only, and it wasn't fully funded. It actually expired before all of the funds were funded, which I think is very interesting that it played out that way, but clearly, benefited many Americans. And to your point earlier in talking about some businesses have had banner years, a lot of that is related to the PPP funds. So yeah,
they didn't put into effect layoff plans and scale backs at the beginning of the pandemic, although many of those were contemplated, and because of the PPP funds, plain and simple. And so they were in a position coming out of some of the early shutdowns, coming out of the debt not being quite as terrible. And then, of course, the compounding effect of multiple businesses receiving PPP, multiple businesses not laying off, kind of that trickle down economic type conversation. And so all of a sudden they were still in a position to really capitalize and not have to retool, et cetera, revamp, go back to rehiring and take advantage of it. And so has resulted in more banner years than I think I've seen in my career, potentially even, Karen. So
absolutely. And we've seen a lot of businesses who use those PPP funds to fund payroll, and then those other revenue streams that were still coming in have been spent on, they've been able to spend those on things that weren't those qualifying costs. And so, again, another reason I think for so many businesses experiencing maybe even the best year they've ever had in the midst of this global pandemic. So.
I think what we're going to see on this, and we'll talk about in a little while, the proposals that are currently out there for a second round of PPP, and there's a lot of proposals, but they're going to be more targeted. The one thing that I think Congress looks back at now and says, well, this money really went out to businesses that were closed, but it also went out to businesses that were doing quite well, and even though there was a pandemic. And I think this next round is going to be more targeted to businesses that saw revenue decline.
Yeah,
like a restaurant.
That's right, Larry. I mean, yeah, I think we've heard 25%, 50% type revenue. I mean, so it's not a 5% revenue decline is what's being kind of advertised out there. Been subject to closure and have seen significant declines in revenue for this next round of PPP funding that's being contemplated.
I think we're actually going to talk about that, what the appetite's for, in a slide a little bit later. So we'll definitely touch on that again. And then continuing on with the CARES Act, the expansion of unemployment, of course, the largest bit of that being an extra $600 per week for an extra 13 weeks. That expired July 31st. But then because of the executive order that President Trump signed, there was some limited expansion or extension of that up to $300 per week of additional federal benefits for states that could implement the provisions of the executive order and could fund the at least a match of $100. So some states have taken advantage of that, some have not. And that's another one of those hot topics that there's still some appetite for some future legislation on. So I think we're going to see more in the way of unemployment insurance as we move through the rest of this year. And then the CARES Act also had, and I wrote the numbers down because they're just so big, it's hard for me to say them, $850 million for public safety, $100 billion for public health, and $30 billion for education that was funded directly into the CARES Act, specifically targeting first responders, clinics, health clinics, and both elementary, secondary, and higher education. So just a huge amount of government funding that's been spent and is continuing to be spent as a result of that original CARES Act. And then I mentioned Trump's executive order. Another provision within that was the deferral of payroll taxes. And I'll just touch on this very briefly. That was an opportunity for employers to defer collection and remittance of payroll taxes between September 1st and December 31. So it's still in effect. And that deferral would go to the first quarter, so due April 30th of 2021. I think in our previous webinars, we had indicated that as a firm, we did not think that was an ideal piece of legislation to take advantage of for several reasons. One of them being if you did not collect and remit that, or at least did not collect that from employees timely throughout the year, and you had an employee who left, then you'd still be on the hook for those taxes, even though you didn't have, you had not deferred it from the employee's check at that time. So that being one of the biggest reasons why we were not recommending that. So, but it is still in effect, one of the few that's still in effect. And then in Tennessee.
And Karen, just to clarify that, that payroll tax deferral under the executive order is not to be confused with the other payroll tax deferral issues, which Paul could speak to, that were in the CARES Act. And so this was really just the ability for employees to defer at the employer's agreement the amount of those federal income tax withholdings that would normally the Social Security Medicare withholdings that would normally transpire in that paycheck. And so did leave a question on if that employee is not there in January, and that's why our recommendation was really just don't pursue that. There was a little bit of noise around it. I'm not aware of a single client that actually agreed to that because of the potential exposure that was out there. And the reality is, 6.2 and 1.45% don't add up to that much, 7.65%. So just to clarify on that. Thanks, Karen.
Thank you. Yes. And then in Tennessee, state of Tennessee has done a really nice job on their website with all of the small business relief that they've been offering as part of the original CARES Act. The states received billions of dollars of federal funding that's being passed through to them. And so as those tranches are being spent by the state of Tennessee in the beginning, those were very targeted to specific industries. One mentioned here, the Tennessee Small Business Relief Funds were a list of industries that then got expanded before that program sunset to be able to provide businesses that had incurred, had either had business disruption or incurred specific coronavirus expenses, were able to apply for and receive relief. We had many clients who were able to qualify for that at varying levels. The newest program that is still in effect is the Surge Grant, and that is an expanded program of the Tennessee Small Business Relief. So it's any business in Tennessee, with the exception of a very short list, are eligible to participate in this. So we don't have that industry list that existed with the Small Business Relief. The eligible expenses for that grant up to $30,000 would be either it's the larger of your business disruption calculation, which is based on 2 periods of time. So you present your information for a period of time in 19 compared to 20. If you meet the minimum threshold, that would be the first calculation, or the actual expenses that you incurred as a result of needing to retrofit your business for any type of, social distancing measures, any direct COVID-related expenses. And there's a really nice document out on the state website that explains all of this program. The expenses had to be incurred, or the losses sustained, between May 1st and August 31st of this year. But you can apply for that all the way through mid-December. So there's still more than a week to apply for that. It's a really easy application process. It's all online. And like I said, that's a reimbursement of up to $30,000, depending upon how much you've incurred or how much business interruption you've had. So just another nice benefit out there for some of you who may be on the call. But just in summary, with everything that's gone on, almost everything we've talked about here is getting ready to end December the 31st, unless something happens, which I think leads us into our very next slide. Ben, if you can, yeah, there we go. So what happens in the future? If we knew that, we all wouldn't be sitting here, right? We would be enjoying the sunshine on some remote island that we own. But if something happens, when could it happen? So these are just some scenarios that one of the most recent article CJ mentioned, we were scanning articles even last night, talked about timing of when this all could happen. So, you know, one scenario, we're past the election at this point. Could something get voted on by the House and then the Senate and be signed by President Trump prior to their recess and his inauguration day? So that's one scenario. And then another scenario would be that there's some sort of a vote, but it doesn't make its way through before the inauguration. So then you're looking at, okay, the House votes after they come back from recess. We're out of the lame duck. We're past the inauguration, and you've got something happening as early February, all the way as late as, you know, we're well into March. So just a lot of different scenarios here of what could happen. One other date that's not mentioned on that slide is just a reminder that the Georgia runoff is January the 5th. So in between the House recess, which I think the House is set to recess December 10th, the Senate is set to recess the 18th, and then the Georgia runoff race is January 5th, and the inauguration is January 20th. So just multiple dates there that could have an impact on what's going to happen.
So
So
Karen, one important date that you really mentioned there is that December 11th, that, you know, the government has to pass a continuing resolution on or before December 11th, or we're going to get a shutdown. And typically those are bills on which provisions can be added. And Leader McConnell has already mentioned that possibility. So it's very likely that we'll see something on or before December 11th.
Absolutely. Yes. Thank you for pointing that out. So then the question becomes, what could we see, right? What are the different scenarios? And I think that's where we're headed next on the slides. There we go. Okay. So the things that have come out this week, there does seem to be some appetite for some agreement, although leadership within the House and the Senate don't seem to be on board with that. There is some contingent in both the House and the Senate that wants to make something happen. These are some of the topics we're going to dive into just a little bit more, but the HEROES Act and the HEALS Act, both, as you can see there, the House passed the HEROES Act, it failed in the Senate. The Senate passed the HEALS Act, it failed in the House. And then we've got this concept of the HEROES Skinny Plan and the HEALS Skinny Plan, where they were trying to come to some consensus. But there are a few provisions here we're going to dive into a little bit more. The things that they seem to be agreeing on at this point, as Larry mentioned, and CJ, some additional funding, some more PPP in whatever form that looks like, maybe more restrictive, limited to those businesses who can show more economic need. Another round of stimulus for the American public. So another round of rebate checks or stimulus checks going out. That seems to have some bipartisan agreement, as well as I mentioned earlier, some additional or expanded unemployment benefits. So beyond the 5 things we've got listed here, those are some items that seem to have some general consensus amongst or across party lines and it within the houses. So mobile workforce, yeah. Go ahead.
Oh, sorry. I was going to say, you know, one of the things, there's a lot of things that are holding this up, and then a lot of things moving. You know, this PPP expense deductibility, which is obviously getting a lot of conversation because of the significant impact. But it's no, if you look at that, if you notice, it's yes, no, no, yes. It's not. So people are switching back and forth. You know, HEROES. You know, basically the House bill switched from a yes to a no, but then the Senate bill switched from a no to a yes. And so, I mean, it's really all over the place. And you're seeing that with a lot of other different situations as well. But, you know, liability coverage for businesses is really one of the biggest things that's been out there. Is, you know, the Republicans have basically said, hey, we've got to we've got to see liability protections for businesses, whereas the Democrats have said, no, that's not right. We need to protect workers. And so that is something that is a big deal that's out there. We're going to talk about what came out yesterday as far as some proposals, but there's just a lot of dysfunction going on right now around trying to get this next piece. It's crazy to think that the last significant legislation that transpired was the CARES Act. I mean, it's just wild, and so
in March,
anyway.
right, back in March.
That's been a long time.
So this bipartisan proposal, as CJ mentioned, 10 senators developed, endorsed by 50 bipartisan House members. So clearly some folks crossing the party lines there. However, as I mentioned, leadership, the Senate Majority Leader and the Speaker don't seem to have much of an appetite for discussing it right now. But the proposal itself is approximately $908 billion. Which is less than what the individual plans that were brought forth earlier would have been on both sides of the aisle. But again, proposed $288 billion for that expanded PPP, $180 billion for the expanded or extension of the unemployment carrying through the first quarter of 2021. More funding for state and local governments who are, as we'll see at the end, are beginning to see the impacts on their budgets. And then additional $82 billion for education, $45 billion for transportation. There's even lots of things in there, airport infrastructure, and then $16 billion for vaccine distribution. So the original CARES Act covered quite a bit with public health, as I mentioned earlier. At that time, there wasn't a lot of talk about vaccine. It was development. It was, experimental type relief. This is, we're now talking about a real clinical trials of vaccine, and how does that, which is proving to be effective, Lord willing, how does that vaccine get distributed in the United States? So there's some funding there for that. All right, this concept of mobile workforce, I pulled, and I'm just going to speed through this very quickly because I want Larry to be able to get to the PPP. But Gallup poll that came out a couple of weeks ago, 51% of employees back in April represented they were always working from home. So in April, 100 people, 51 were working from home all the time. That's come down now to an average of about a third. And by the inverse of that, back in April, about 31% of folks said they were never working from home, that they were always going into wherever their place of business was. And that's increased. That's up to 42%. So what we've seen from March through the end of October into early November, and it's shrunk back a bit in the last couple of weeks, is that employees are mobile. They have been for a while. Over the last 10 years, I think it's increased more than 200%. But with that comes this appetite for legislation to help with mobility. And because of the nature of the COVID pandemic, and specifically because of the healthcare workers. So those healthcare workers, those frontline workers who were rushing from Texas to New York or wherever the hotspots were coming at the time. There's some real appetite here, and that's where Senators Thune and Brown introduced this legislation that really at the heart of it was meant to protect the employees and also the employers who were sending their employees all across the United States to deal with the pandemic and try to limit the burden on administratively having to file for payroll taxes and creating nexus in all these states where employees were working across states, maybe just for a very short amount of time. So there's definitely some additional appetite for that. And there's been some other representative out of Georgia back in January had introduced a bill where calling for sort of this national agreement, national rate, if you will, for workers who were spending, less than 30 days in any given state, just trying to make that a little bit less burdensome. Contrary to, I guess, the way we were talking about a year ago, the Wayfair legislation had gone with sales tax. This was kind of moving in the opposite direction. So I don't know, CJ, if you want to share anything else about that.
Yeah, I mean, I think it's a pretty big deal just because Nexus and traditional Nexus rules are out there. If you have somebody sitting in the state working, unless it was kind of this, there's a uniform act that's out there that a lot of states have adopted that would allow someone who is only in sales, working out of their house, not to trigger those Nexus requirements. But what's happened, especially if you think about some folks, up around New York, New Jersey, folks that go to work on a train and they're moving between state lines, et cetera. Those people are now, sitting in a state that's out there that would potentially trigger Nexus. You got the same thing, honestly, here in Tennessee, with folks up right across the border in Kentucky or down south in Alabama. You're an hour each way, roughly. And so, now somebody that lives in Kentucky is working from home instead of driving across the border to, to Clarksville. Well, that's a big deal. All of a sudden you're filing in Kentucky where, oh my goodness, they've got a different state income tax requirement. Oh, and for the individual flow throughs, it was subject to SE. Now you're paying Kentucky tax. And so those triggering of Nexus things are a big deal. And there's some good conversations around this. It's exciting to see, in today's modern workforce, this is and there's some good support around this, which is really exciting. It's going to reshape some of our Nexus discussions around state and local income taxes, but I think it's about time. Just like Wayfair hit the reset button, this would hit the reset button potentially around some of these work from home Nexus issues that we're dealing with right now, particularly because everybody has people working at home, especially right now.
All right, Larry, I'm going to toss to you.
All right. Thank you, Karen. So we talked earlier about the non-allowability of expenses that are used to obtain PPP forgiveness and the dispute, I guess, between the IRS and some members of Congress as to whether that was the intended outcome. As was pointed out earlier, a number of the bills that have come and been presented in Congress did clarify that the expenses that you use to get forgiveness would be deductible, although other bills did not have it. My suspicion would be that as we get to the end of the year here, or if the stimulus bill trickles over into next year, that the scoring of this is going to play a major role as to whether Congress will or won't do this. When you look at the $525 billion of PPP loans that are outstanding and, say the average tax rate of 20%, we're talking $100 billion of revenue that the government would or would not walk away from. And as Congress starts contemplating this as part of a larger package, I think that number is pretty big. So I can't really handicap this as to whether it would or would not happen. I think we're just going to have to wait and see where Congress is going on this. Probably more optimistic about some kind of simplified PPP forgiveness. There was a hearing yesterday in the the Senate Banking Committee where Chair Powell and Secretary of Treasury Mnuchin were present, and a couple of the senators did speak up about the need for the $150,000 automatic forgiveness. And particularly they were kind of targeting Secretary Mnuchin about how difficult it was, or at least the time lags that businesses were experiencing getting that PPP loan forgiveness. One of the senators mentioned in 9 weeks after his constituent had filed. So I think there's more support for the PPP forgiveness, automatic forgiveness, maybe a little bit less than over the summer, just because of the emergence of more and more evidence of fraud. I think some Congress people have stepped back and said, well, maybe this isn't such a good idea just to automatically forgive everybody. So we'll have to see how.
And I think that's the core of it, right, Larry? If all of a sudden people are, it's become very apparent that there was just tons of fraud that transpired. Hey, here's free money. Just fill out a simple application, particularly with some of the online banking institutions. Yeah. There was widespread rampant fraud. And so now people are actually having a chance to look at the data and look at the actual borrower and the expenditure of funds. And I think the conversation has changed to say, you know what, actually checking to see if these people really are in business and really did use the funds, maybe that's not a bad idea.
Yeah, there was an article in Barron's a week ago about a house in a suburban location that applied for 40 EDL advances as an agricultural business. So as congressmen see this, it makes them concerned that whether that would be the right thing for them to do. And then I guess the last thing with respect to PPP is the extension of that to 501c6 organizations, which are real estate boards, chambers of commerce, whether those would be included in the next round of PPP. We'll have to wait and see.
That's great, Larry. Thank you so much for all that insight. And I'll just kind of close this out here by saying, why is it that the Democrats have been so focused? You have this liability issue on the Republican side. Hey, if there's not liability protections, we're not moving forward. And over here on the Democrat side, you have, hey, if there's not money for states. And I think both of those have been really politicized and become rallying cries of different things. But the reality of it is there's common sense in both of those. And the reality is that look at this map. This is a great example of what states are seeing, particularly those that are subject to tourism and or 21% up there. You see that's oil. That is based off of separation taxes that are out there for when we pull stuff out of the ground. And so you see some states. I mean, look, these are double digit. I mean, almost every state's double digit declines. And I mean, it's just really, really a big deal. For 2021, these projected tax revenue declines that are out there. And the reality is for last year, 2020, a lot of states have fared okay, candidly, but they are thinking that's not going to continue. And of course, the ones that are the worst off, the most red states here, did not do well, generally speaking, especially in the later portions of 2020. So, I mean, it's a rough landscape out there. And the reality of it is that, states do need money, do need funding. And, we're blessed here in Tennessee. We actually are above budget. Things have gone relatively well, but they're still projecting a double-digit decline next year right now, just based on the reality that this is not over and it is carrying forward. Infection rates are the highest that they've been. It is closure rates are coming back on, obviously, in Nashville Metro. You've seen that. We've seen that across the country. And we're not quite out of the woods. Great news out there, but there's still much work to be done. And so, Karen, thank you so much. And Larry, I think you may be free now, but so grateful, Karen. Do you have any closing words here before we move on?
Nope, you wrapped it up beautifully. Thanks, guys.
Thank you, CJ.
Karen. Thank you, Larry. Thank you so much for your leadership around Triple P and relief throughout this entire process. So, well, with that, a little bit of a switching gears here to what we've kind of dubbed the need for real relief. There's been a lot of conversations around the reality, and this has been a big thing at our firm. It's a big thing with our clients who've been consulting more on the operational front. People are stressed out and worn out and tired and ready for something to give, so to speak. And especially as we go into new waves of lockdowns and new waves of operational modifications, et cetera, this is a really great session here that we're going to lean into. I do want to make sure to just kind of clarify a little bit. This is we're moving from a very technical discussion to what I would refer to as a little bit touchy-feely. I spent 2 years in the mental health space, actually, and so I'm excited as a group therapist, actually, in wilderness therapy for at-risk youth in recovery. In addition to living outside in a tent for a little while, I did thousands of hours of group therapy as well. And so this is really near and dear to my heart. And as we get into it, I want to make sure that for some of our folks that are on here, this next session is definitely going to have a spiritual leaning as well. So if you are, not open to having a discussion around more spiritual type concepts, because this is going to be both a mental health discussion, but from John Murphy, as I'm going to introduce here in a moment, takes it more the reality that our spiritual well-being is tied in with our mental well-being, tied in with our physical well-being. And so as you put all those things together, and particularly from the perspective of God with a big G. And so if you're not wanting to hear that, then I'm going to let you get off the line and go take a great break. But I think there is some, regardless of what your personal belief system is, as we walk through this, there are some great tenets around mental health and how that's built out. So have an open mind and discussion. And John, with that, I'm so excited to have you. John, if you don't mind unmuting yourself and saying something, maybe you'll pop up.
Yeah, great to be here.
On the line.
Great to be here.
Sure don't want to. Good. All right, that's wonderful, because I don't want to try and cover this one by myself. That's for sure. As our special guest, I'm so happy to have John Murphy. We've actually worked with him with some of our team members over the years. Rock House is an amazing organization and does great work helping with mental health, and particularly when it comes to relationships, et cetera. And so I don't want to steal any thunder from you from John, but John, welcome.
Thank you. It's great to be here. I also appreciate all the other information. It's really helpful. I'm one of those PPP guys, so I'm out there in the same shape everyone else is in. You know, will it be deductible? Will it not be? Thankfully, I'm not looking to the government to give me relief in my spirit, because we don't know what's coming, right? So I'm going to have to figure out how to get peaceful no matter what comes down the pike. That's kind of what we're about. Let's see. So it's time now to move
awesome,
from
John.
economic man to emotional man to spirit man, and because it is where we live, right? It's kind of how life feels, is what's going on inside of us. Let's see if I can get the click to work here.
That's
there you
right,
go.
John.
Well, because
Yep.
most folks don't, everybody knows who Blankenship is, right? And they might have heard a couple of our radio ads, but they don't really know who we are. So I thought I'd give them just a little overview of our background. We've been at this since we're in our 15th year. And it really started when, after leaving a couple of posts as senior vice presidents in public companies, I really got moved to walk into what was happening from a perspective of spiritual growth within me, and the greater and greater levels of peace I was able to have despite what was coming down the pipe in my world. And as I began to dig into that and go deeper into ministry, a lot like you did, and do a lot of counseling, working in spiritual settings, it began to reveal itself. For instance, worked at the Mission downtown in the context of their recovery program. And it started kind of coming together. And then so I ended up writing a book called Be Transformed, New Life Awaits, because there is a spiritual piece that if we address as believers, then we're able to really experience life in a very different way. So that first idea has grown to, we now have a team of 13 people. Our total capacity annually to deliver counseling is about 12,000 hours a year. So we have a lot of capacity to help a lot of people, which is great because we're very busy, even have backlogs and so forth, even with that much capacity. And then to understand our geographical coverage is kind of interesting, because we're in 27 states. And that's because we've been Skyping and Zooming for 10 or 15 years. And when COVID hit for us, it just meant getting good at what we were doing. And we did. It really challenged us to smooth out our process, smooth out our documentation and so forth. So we're one of those folks that the challenge of COVID actually increased our efficiency, increased our ability to effectively deliver help in a lot of places, including some countries, which is kind of interesting that we are in 6 different countries doing counseling work. We've had clients in Moscow, clients in Taiwan, just in various places, mostly because of some connection with someone here locally. That's how we got to know them. And then we've taken the concepts.
And John, I mean, I'm so sorry. Go ahead.
Go ahead. I was just going to say, and then there's the ministry piece. A little delay here. I apologize. You were up.
It's John. I'm sorry about that. But I was going to say, as that expansion, because, the COVID has been a worldwide pandemic, that has affected folks all over the place. An opportunity not only to lean into folks here, but also across the globe. And I mean, that is really, the impact of COVID that has transpired. That have you seen, the demand. You mentioned being adaptable and being able to adjust given things. But the reality is that adaptability and adjustment that Rock House has done a great job adopting, a lot of folks, and if you don't mind advancing the next slide, Ben, have struggled through this period. And so, John, maybe talk a little bit with us about this impact that COVID is having on the mental health of people that you're seeing.
Yes, and it's in the newspaper, and you can really see what it is. But there's a huge increase in stress, a lot of fear, and then a lot of loneliness, which has come out of isolation. And the isolation has actually increased fear because it's cut us off from the things that we look to and count on for peace. So I think the overall bucket is just to call it a loss of peace across the board. And then that's resulted in obvious self-destructive behaviors, a lot of substance abuse, self-harm, of course, moving into suicide as well. And so there's been a lot of carnage, and physically and emotionally, as a result of what's happened with COVID. And then relationally, we've got the increase in marriage conflicts, a tremendous amount of conversation about that. But probably the greatest increase as far as we're experiencing it are folks who are really wrestling with the parenting situation now. The parenting's been turned upside down. The kids are home. The parents are frontline. They've got to figure out what this is. And so that's a huge stress. And then on the other side, and of course, they're not necessarily trained to be teachers and trained to drive this new aspect of their children's lives. And then the children are cut off from what was a huge piece of their lives. And they get a lot of satisfaction or relationships going on there. There was a lot of things that they were depending on for a sense of peace and assurance about life. And I think that if nothing else, it just shows that there's the huge potential for disruption. And so that is a loss of peace just in the loss of believing in the consistency of things to continue. So a lot of wrestling with problems there. And then on the business side, the productivity losses, which it varies depending on which business you're in. And my son, my younger son, has been in a business that's been associated with parents. So he just works at home and he's pressing in, and they're busy, and it really hasn't affected his world much except that he's at home. But then there are those people who, there are millions of people who don't have jobs. So it really varies on who that is. And there are varying levels of loss of peace and fear wrapped around really kind of where you were standing when the COVID thing hit.
I think you brought up a great point there, John. Sorry, I know we're on a little slight delay between the two of us, so forgive me. But, the change in the parenting structure and what our kids are going through. I mean, those are two really, really big points that I think a lot of folks don't appreciate, or at least don't give it the mental time and candidly grief processing adjustment that needs to transpire, because we not only as parents are having to find ways to balance, maybe both parents are working from home, or one parent's working from home, but the other one is required to be in the office still for their job. But then the kids have been sent home because the schools have shut down and gone remote learning. And so all of a sudden now you've got parents at home trying to work because they're still trying to work. And maybe they aren't taking advantage of FFCRA like we talked about earlier, which is a really great thing that's out there to help with at least 2/3 pay in that scenario under the Expanded Family Medical Leave Act. But it's creating a lot of angst and a lot of tension, not only between children that are understandably stressed and pushed to their limit, but don't necessarily understand that or can't function with it. And then you layer that on top of the dynamics that are happening at the relational level between spouses in caring for those kids and trying to balance responsibilities of work on top of that, all in the midst of all of the other shakeup at the top of that list.
Yeah, no question. And the snow day grid that everybody had in their head, the kids are coming home from school, that blew up in about 6 hours. And they go, no, they're staying here. And so people are just confronted with I have no idea to do this. This is a completely new world. And obviously that brings a lot of stress relationally in the marriage, as well as with trying to deal with how do we handle the kids, how do we manage them, how do we parent them through this situation. Another interesting aspect of the previous point was just about the business side is, people, when they are losing their peace, and people have a lot of reason to lose peace, they don't function as well at work as they used to either. So there's a lot of loss of productivity, which is very real in that aspect too. So it really all boils down to what is driving this, what's underneath the loss of peace. And I think we just kind of have to look at where peace comes from to start with. And that comes from trusting. When I can trust something, then I have peace about it. When I can't trust something, I don't have any peace. Well, the thing that we are drawn into doing, and that people are inclined to do, made to do, built to do, is that they need something that they can trust in that's bigger than the challenge of their life if they're going to have peace. Interesting concept. If I've got something that I can trust in for peace and assurance and to provide the thing that I'm looking for that gives me assurance about life, and I trust in it, that's great as long as it's trustworthy. But I think what we found is that a lot of the things that we may have been counting on for life to feel good and to have peace could be anywhere from our job to our bank account to our relationship, a lot of things like that, access to people, access to video games, whatever it is that we're counting on for a sense of peace. What we have found is that COVID's bigger, because we all sort of had our trust grid that was working in the world the way the world is now. But basically, COVID has shown us that we cannot really rely on we can't have peace based solely on the reliance of our own skill sets, assurance in ourselves, nor can we have peace. Is it legitimate really to be at peace about things continuing to be the same on the planet, right? Those things are changing, have changed massively, and it's a very different world. So I think what we found is a lot of things that were part of our trust grid, which brought us peace in our own construction, has been proven to be not effective. And this is, I believe, the way God built this really is that the highest state of well-being is achieved to the degree that you trust in your God, whoever that may be, for life, for assurance about life. And that's a really interesting thing, is that when we are in a situation where we are wrestling with a problem, we have an issue coming at us, how common is it to try to think about where am I going to go in my head to get myself peaceful about what's coming? And the sort of a common situation would be like my lucky tie if I'm a sales guy, or my lucky silver dollar, or, I mean, the little g there is because people have, even though they might trust in a deity, they have a certain spiritual superstition, at least level of trust in something, rabbit's foot all the way down. It's something is a little bit that they're sort of leaning on that's not really concrete, but they feel like it's going to work out for them because of some circumstance. We're now kind of pushing into things that are beyond reality. We're pushing into what is our God? What is the thing that we go to feel okay about things? And it can be either, it can really be anything.
It is. And, to that point, John, I think the reality, I love that trust grid perspective, and because fundamentally, I think a lot of people have a lot of trust in themselves and their ability to overcome. It's kind of the American dream, their ability to, their ability to impact and shape their own life. And so when COVID hits and all of a sudden your ability to overcome, your ability to impact and shape, freedom's changing, having to comply with outside requirements, but also the very, very true reality that we are not in control. And for a lot of people, being in control is a huge part of where their trust is. It's that self-reliance and not being dependent upon an outside, a higher power or the Lord to be able to direct and shape, and really giving over. We may say, hey, I give my will and my life over to God and to, follow it. But when it comes to the rubber hitting the road and actually living that way, this COVID and the shift and the change has revealed that in a lot of people.
That's right. It's exposed it. And what's also interesting is that we do a lot of work, and almost exclusively with folks who consider themselves Christians. And it's interesting that they're wrestling with this, and you go, well, wait a minute, you have God. How did we get in this situation? And I think because the Christian culture has been oriented, certainly in this country, is that I accept the proposition that I can't save myself. So I'm counting on God, and I trust God for that salvation and what he has offered me, and I accept that. But a lot of times we don't move beyond that into trusting God with our lives. Is that, okay, the way I handle the issue of salvation is this relationship I have with the Lord, but I've got a whole lot of other issues, and those are ones that I might be just as inclined, and probably more inclined, to figure out how to do it through my own strength and my own processes and my own rationale to get at peace about those challenges. So that's an interesting aspect of where we are as believers, is that, salvation and Christianity is really supposed to be about sanctification, which salvation is the first step of a process of constantly moving forward in a place of peace and assurance in God about all the aspects of our life. And so it's an interesting sort of place we are. And we would say, well, maybe the Christians have got this. Not. Well, actually, we work almost exclusively with Christians. And it's just a condition that we are in. And I think now we do work in Africa, it's less of an issue there, because there's not a lot they can count on there. And there's a whole lot of counting on God because they just don't have any other resources or options. But depending on our life story and when control kicked in versus trusting, then we may be functioning at a really high, really control thing. And through our control, we build our grid through our control. It's our construction. And then something bigger than our grid comes up, and then we lose our peace because it's not resting on God, it's resting on our grid instead. Make sense?
Yeah, that really sums it up right there, John, because when things do change and we get shifted and it reveals potentially misplaced trust, or false trust, this false belief, whether you're a believer or not, if you actually believe that you're really in control of your life, Well, there's about, a couple thousand years of history that show that that's not the truth. And so what happens is we get in these mindsets and this process of where we're trying to manipulate, we're trying to control. And when we do that to other people around us, whether it's coworkers, it's, spouses, children, and instead of understanding that, that people have choice and it's at work and you can't control it, and you learn to react to life on life's term, it's a completely different process. And candidly, when we get outside of that, it creates tension and it creates conflict, and then it spins from there, and
Yes.
and then it results in bad decisions, emotional decisions that aren't based on truth.
I think a lot of the conflict comes out of a misunderstanding. And this first concept here, I think, is really critical, is how someone behaves is about the condition of their heart. How their behavior makes you feel is about the condition of your heart. So that's so
Right.
interesting, is that, so we're looking at, why can't these people just stop it? We're saying we get frustrated and angry at them. Well, the reality of it is that there's something they may intellectually know point three, they may intellectually know what it is they're supposed to be doing, but their heart, the deepest part of who they are as a person, just can't go with it. So, I mean, why do we walk into a restaurant and say, I know I absolutely will not have a dessert today. And we go in the restaurant, we order two. So what's the difference? I mean, the difference there is the difference between our head and our heart, right? It's like our head knows what to do, but our heart is about ready to is going to tell you what's going to happen next. And that's always the case. So we need to understand what we're looking at. What we're looking at are people who are not necessarily defiant. They don't have anything against you, but there is a driver in them that if they have a particular behavior that they're depending on for their peace, you're probably not going to talk them out of it, and you certainly are going to get there intellectually. And if you try to land on them as a parent, then on the behavior side, then you're not going to have much success. So what we have to do is move into how do we actually address the heart issue, the heart loss of peace, and resolve that, because then that resolves the downstream behavior. And that's, that's the centerpiece of what we do here. So, so the question is, what do I do now? So if I'm in this situation, what do I do about me first? Well, the first thing we want to do is trust what is trustworthy. Obviously, COVID has shown that we and our control and all the things that we may have to try to use to lean on for trust and to get peace, they're not really trustworthy. We need to have something bigger than our problem to trust in, to have a sense of peace about it. And so that, to me, because of my faith background, says we've got to connect with the one true God, and we've got to figure out this Proverbs 16:3 scripture is so important. We need to figure out how to give it off. We need to figure out how to trust him and commit to him wholly the aspects of our life, the work of our life, the mission of our life, just our life, and the burdens of it. And then what we hope to do is in that place of trust, that he will lead us through it, and that he will hold us in a place of peace. He talks about walking us through the valley of the shadow of death, and we are able to be at peace. God's proposition is not to take away the circumstance. His proposition is to take you away from the oppression of the circumstance. He is to allow you to have peace that makes no real sense in the midst of your struggle. So people who are further down their faith and trust side have hit COVID going, and we've had even clients tell us, if I had gone through COVID before coming to a Rock House, this would have wrecked me. So obviously it's this process of moving that level of our dependency on peace onto God. And then that's really where the change is going to be. And that's the first thing we need to do, is work on ourselves. What do they say to you in the airplane? Put the mask on yourself before assisting someone else, right? That's the message. We have to work on, we don't try to go out and control and fix everybody. We start getting ourselves to a place of peace. And that's the most powerful next step. And then the question is, how do you take that out to the world, starting with your family? Well, it's not to go in there, beat them up and tell them, hey, you need to start trusting God and wear them out. What we've seen is most valuable is simply living in that place of trusting God with things, and then just living that out in front of them. And what we've just seen over and over again is that, through testimony, people will eventually go, what is it that you've got? Why is it that you're peaceful in this situation? It's so interesting in marriages, because we'll have one spouse come in and then start getting real movement, a sense of peace about life. And then somewhere between 1 week to 2 years later, the other spouse will call in and go, I want what she's got. How do I get that? And so that's really what happens, is that as we just demonstrate what God has done and basically live out the testimony of his movement and speak to him and give him the credit instead of taking credit for what's going on inside, people will ask to be invited. Not only do you have the opportunity to always invite, but people will be asked to be invited in. And then from the, oops, blew past the slide there. And on the work side, keep in mind that when you're dealing with productivity issues, the real movement, once you've trained them and they've got the skill set and you've told them what they need to do and the comp plan is in place, if they're not producing and their productivity levels down, you're in a heart issue category. There's something going on inside of them. And in a lot of cases, the COVID thing, even though the business that that person may be working in is still very viable, the home situation is now coming apart. So they're 90-10. Their brain, their mind, their heart is processing about what's going on at the home. So their bandwidth is just shrinking, and therefore their productivity. They're losing their peace at a huge rate. They just don't have what they used to have to do their work with from an emotional perspective. So for that reason, you really—
I think that's an important— oh, sorry, John. I think what you just said there is so important as, as business owners, and the issues that potentially are showing up. And, we've been talking about this a lot at the firm. We have a triple R program going on right now: rest, relaxation, and rejuvenation. And the reality is that most of the stressors, if someone comes to work and they don't have their full being because they're distracted, because they're having to deal with things that require their attention and that are healthy things, their family, their relationships with parents, or relationships with the children, relationships with spouses. These are really important things that they should be focused on, and are experiencing extreme tumult and upheaval, as we've talked about previously, because of the circumstances around us. Because the reality is, as individuals, we oftentimes think that we are in control, and then that fallacy spins out of control, and then the manipulation and the things that we do to others, trying to get them to, candidly, in a selfish way, perform or give us the things that we're after.
Absolutely.
And so, that creates conflict. And so you come to work potentially with that conflict in place, and that distraction that transpires results in less productivity, which across the board, if you look at business surveys, that's exactly what has transpired. Jamie Dimon said, as soon as I can get people back in the office in New York City, I want every single desk full that I can have full, according to statute, because the reality is there is a lack of performance that's transpiring because of the distractions that are transpiring in the home. And now those distractions, I want to say, they're not bad. They're good. We need to lean into our families. We need to lean into these personal relationships, but they are real, and it does have an impact. And so what becomes important is, what is the solution? Like we talked about, John. Well, the solution is realizing that you're not in control. God is. The reality of it is that you can't shape all these outcomes, and you have to learn how to deal with life on life's terms. And as you begin to understand that, and realize that, I'm not here to manipulate. I'm not here to try and control. I'm not here to try and get the outcome that I'm after, but to accept it as it transpires, and then to work with others to do that. Talk about spreading it. And that results in change, and that results in, that acceptance of reality and that lack of manipulation, and having that peace. I love the trust grid, having that peace placed in the right space instead of us. It changes the way that you experience life. And then you come to not only relationships whole, but you come to work whole. And then overall, that flips the cycle, that flips it back in the right way and changes the outcome.
Yes, and if we can trust God in this situation, He redeems all these things, right? He's the redeemer of the situation. And what happens is that when you take these things to Him and start trying to go to the real source of peace, then what you find is that He redeems this bad situation by giving you greater peace and greater depth of relationship with Him. So in every case that we get a curveball and a loss of peace, there's always the opportunity to have that conversation with the Lord and try to figure out, why have I lost my peace? What am I depending on instead of you? I reject that. Please fill that place in my life. And what you will find is, I've experienced in a lot of testimonies I could give you, is that there's a sense of deeper connection and a sense of deeper peace that comes in the outcome. And it is the redemption by God to give you more of Him when we are in these situations. Not more stuff, but more of Him. Something that's really enduring, something we can really trust in. So when we're in the work scenario, where do we move from here? And of course, it kind of depends on which sort of situation you've got going. Obviously, if you have a faith-based EAP, which is what Rockhouse does, we offer faith-based EAPs. We take the spiritual track to try to help people rebuild this grid of theirs and bring them to peace and help them get them to greater levels of productivity and improve relationships and all those kinds of things. And of course, that's obviously what I would recommend in every situation. Even if you have an EAP, having a faith-based EAP beside it for those people who want a faith-based solution. There are a lot of people who don't want a secular solution. And I could show you a lot of data that would say there's some challenges there on the secular side in terms of the efficacy. But whatever it is, get them talking. If you got a secular EAP, get them to call it, encourage them to do it. And one of the most important things I've noticed in our EAPs is make sure that the employees really feel free to take the time to have the meeting with the EAP. Because if they, right in this sort of survival mode, for them to pull out and work on their inner self, which is absolutely critical to survive, it is very hard for people to do that in the face of the demands of the business. So you really have to be very pointed as a manager to tell them, take that time, call those people, get your peace back, so we can use you. Because right now you're losing your mind, and it's not really very effective for you just to get in here and spin and stare at your computer and not get anything done. And then, of course, through a secular EAP, you can get two counselors, or they can just go straight to the counselor themselves. But we need to encourage them to address what's going on inside, wherever their access is, to get that addressed. And I think that, I've really said a lot here, and can really have a very unique proposition and a perspective here. But I think it's important for people to understand that we are data collectors, and we have proof of what we're talking about. Some people say, oh, all this guy thing, that's kind of willy-nilly, that's spiritual, that's kind of the individual. But what we have, and we've created Mode of Transition Therapy, is the therapy that we use at Rockhouse Center. And it is based on this belief that spiritual health is mental health. And it's really important, I think, to just show them the numbers that you guys at Blankenship help us put together. I mean, these are the results of 358 people where you folks came in and looked at our pre-assessments and post-assessments, validated them as being true. You did the math. These are y'all's numbers, Blankenship numbers here. I just copied them off your report. And so you can see that there are massive changes in the way life feels: depression, anxiety, stress, fear, grief, rage, all these kind of things that we're feeling more of because of COVID. Massive reductions in each of those through this approach I'm talking about, because it is so core, and it's not really something the secular people are skilled in or even have the opportunity to, because of regulation and how in their training, they don't really have an opportunity to address it. And of course, we feel like that this is all because of this, which is here we also track how they report, how they're doing in their relationship with God. And here is the movement that they report, looking at these things and going through this process. And we think all the emotional movement comes because of this movement. And so I just want to say that this may sound, too spiritual, non-concrete, but we've been tracking data for 10 years. We now have a third-party validation, and this approach is massively effective. And I will tell you, you're not going to find these results in secular health. They just do not exist. I've read research paper after research paper, and the sustainability of this has also been proven out.
I mean, John, you hit the nail on the head there, in that there is a difference between secular data and spiritual-based or Christ-based data. And that's been my world with Christian Recovery Houses. A lot of folks that know me well know that that's a nonprofit that I've been working with since 2006. And the reality of it is that people in recovery from drug and alcohol addiction doing 12-step work, if their higher power is God, as defined in the Bible, their recovery rates are, double-digit higher than those that have a little g higher power, so to speak. And so, it's just, fact, data is data, facts are facts. And so, when you get into the reality, if you, my belief system, who I am, what I stand for, what we stand for at our firm as well, let's deal with the core issues here. And so the reality, John, is that people, when they have this trust grid that is misplaced, and then it gets disruptive with outside factors. We've had, if we go back 2 slides real quick, Ben, if you don't mind, when we have these emotional depression, anxiety, stress, panic, fear, grief, right? All these things that transpire, go back to March, April, May. This was at the forefront of employers and employees' minds. And so when things emotionally start transpiring, the root cause is this misplacement in trust, whether it be in ourselves or be in our surroundings, our ability to control, et cetera. And so by readjusting and refocusing our trust on what matters most, we are able to experience true recovery and true relief. And with that, John, we've got to move to our next piece on estate planning, but I'll let you close out. Thank you so much for joining us today and sharing your insight. You have helped be a tool to shape and change so many people's lives.
Well, I just really appreciate the opportunity, and I've really been enjoying the information that Blankenship's offering here. So I'll be listening for the rest of the day. Thank you.
Thank you so much, John. Appreciate it. And so with that, we're going to switch gears back. That's our sandwich in the middle here, the need for real relief. Thank you, John. Thank you to your team at Rock House. What a great organization. And if you shared, we've had a chance to look behind the scenes and look at that data. And I mean, those are real numbers. And that's what accounting firms do. We audit and we attest to. And so thank you for being a part of a little switching gears here. So we're a little behind. I apologize. Hopefully we can get caught up here through the end. We're going to go really quick. We have an estate fireside chat that we did a little bit ago. That's going to be posted. That's kind of a precursor for what we're going to be talking about today. I'm welcoming Ann Waters and Don Coomer. Ann, Mr. Coomer, I hope that you can speak up. Let me see if you're out there with me.
Can you hear me?
There you
CJ,
are,
this is
Ann.
Ann.
Great to hear you.
Glad to be here.
Great. Oh, welcome, Ann. Great attorney with our firm, CPA, amazing background, Duke and Vanderbilt Law. We're speaking of goodness, Duke, Notre Dame. I say that every single time, man. Notre Dame.
Okay.
You've got a new Notre Dame graduate on the Supreme Court now, right? Finally, representation.
Right. And the football team is doing pretty well this year, too. We'll take it.
That's right. That's awesome. And Mr. Coomer, are you out there by some chance? We may need to unmute you.
I am here. Can I be heard?
Wonderful. You are, and you look great. Welcome, Mr. Coomer, who has
Thank
spent a
you.
career of a couple of years, right, Mr. Coomer?
Working on 3. Working on 61.
Oh, what an amazing bevy of information. And I am super excited for what we're getting ready to get into. You guys are in for a real treat. We had a great fireside chat. That'll be posted out there as well. That is almost sort of a precursor, honestly, to what is transpiring right now. And but we're going to dig into this in light of a lot of different pieces that are going on in the estate tax world. Oh my goodness. We hope today that you can leave with a great understanding on estate planning and when to act, which is now. Little spoiler alert here, and some important concepts. And so with this, let's go to the next slide. And Mr. Coomer, I'm going to let you guys start taking away. This is just going to be a chat format for all of our listeners out here, but we've got some foundational things to talk through. We can't get as in-depth as we'd like. Go back, watch the fireside chat. That's going to serve as a foundation for some of these discussions. But we want to just kind of give a little background for estate and gift tax. Take it away, guys.
Yeah, may I, a couple of comments, if I may, to start with. It's really interesting listening to what John said a while ago about heart and head and where one puts one belief and confidence. And it's really been interesting to me just to watch for those clients that I still have some relationship with, what has happened during this time of stress and the impact of the COVID and the isolation and the sequester that we're all living in and the stress that we're living with. And as we talk with people about estate planning or what are you going to do with your stuff, we all got stuff. Some people have more stuff than others, but we have stuff. So what are we going to do with our stuff? It's interesting. I've sensed a couple of changes in attitudes, and I have said for years, and I heard you say earlier, we don't do everything for tax purposes. And one of the questions I always like to ask people is, what do you want to have happen? What do you want to have happen? Well, if we do this, we can save all the tax, but that doesn't accomplish what I want. I think it's important, and I do see some changes in attitudes about, and it may go back to what John was talking about a while ago, the sense of insecurity, the depression on what do I place my confidence. Well, if one has placed one's confidence on government, one may be a little bit unsettled right now because it looks like the game rules are changing every 4 years. So if I'm planning a 20-year estate plan, a 30-year estate plan, or whatever estate plan, and rules are changing, I might make a mistake. So let's talk about what we want to have happen. Let's see how we can accomplish that. And didn't mean to take too much of the time starting off. You got it.
No, I think that's really valuable, Don, because I do think it's interesting that we followed the previous conversation as well. What I find most of the time that keeps people from making a plan is they can't get peace about it. They're afraid they're going to make the wrong decision, or they're afraid they're going to leave their children in a situation that may not create an environment for them that's going to be the most positive for them long term. So I do think one of the things that I go into every meeting with as well, Don, is what are you afraid of? What are the things that if we create this plan that you're worried could go sideways? And I've really changed my approach from starting out with tax driving the conversation to what are the things you want to see happen and what are the things you're most worried about could go wrong. And there are ways we can create side railings in some of our documents to protect our children, sometimes from creditors, sometimes from potential future divorce. Some of your children are not even over 18 yet. So we're trying to plan for the rest of their lives. And so one of the number one things we try to do is build as much flexibility as we can into the documents, which we're going to talk about a little bit in our slides moving forward. But with the current change in the tax law, that has even become more important. So basically where we are right now is that everyone can give away up to, it's 11.58 million for 2020. It's set to go to 11.7 million in 2021. It adjusts with inflation, but with the new administration coming in, there is definite talk that that number will be dropped significantly. So one of the things that we're strongly recommending is that everyone look at their current situation, kind of try to do some long-term budgeting for your lifetimes, determine, do I have room here to do some gifting now? And if you do, this is probably the year to try to get that done. So gift and estate exemptions are unified. What that means is you can give the 11.58 million during your life or at your death. Any value above the exemption is taxed at 40%. So for those of us that have been doing this for a while, these numbers are really hard to even wrap our brains around. I mean, some of us started, it was 600,000. In 2000, it went to 675. In 2008, it was 2 million. And again, now for 2021, we're looking at 11.7 million per person. So where you have a married couple, we're doubling that to 22 million. 2023.
I mean, it's crazy, Ann.
It is crazy.
Yeah, I mean, it's just wild from a perspective, right, Mr. Coomer? I mean, it is just, it's amazing the amount of money that we can give away tax-free right now.
Yeah, and one of the questions that I've been asked, in fact, I've been asked 3 times within the last few days about 3 different individuals, just that random phone call. What's going to happen in January, or how soon is this going to change, if it changes? Well, I don't know. I would like to think it would take a year for Congress, and especially depending on the makeup of the Senate, one thing, which we can't predict right now, as to how quickly something could change. But, and I would ask the question for all the learned minds out there. Let's say that House and Senate do agree to make these dramatic changes and they go through. Is that going to be effective January 1, 2022? Will it change mid-year where we'll have a bifurcated rate? I don't have a feel for that. Somebody may have. I do not.
Yeah, and Mr. Coomer, I mean, to that point, and I did actually, throw in the Biden plan, just because it does play into kind of this foundation that we'll just briefly go over. But there is a lot of uncertainty right now. We have this amazing situation where, we can give away more money than, I mean, it's just mind blowing that we can give away, like over $23 million if you're married, filing joint, if you have both spouses exemptions in their entirety left. And whereas we used to do estate, and so now you're really only doing estate planning for folks that are up at the higher, these higher estates, pretty wealthy if you've got $20 million to give away. Whereas when we started doing estate planning, we did it literally for almost every single client. And so the normal plays of A and B planning where you use one spouses, et cetera, we would do this all the time, literally with almost every single client that came in the door. And now, A and B planning, which is, one spouse leaves it to the other, you get a step up in, fund an initial trust, that's kind of with what we have right now called portability. I think portability is going to be around for a little while. That's pretty popular. But what we do have, so this 11.58 million that's out there right now in 2026, as the law stands today, reverts back to 5 million. So if nothing else transpired, TCJA didn't go away, Tax Cuts Jobs Act didn't go away, we're already set to go back to 5 million. But one of the reasons we're talking about this, we talked about the Biden tax proposal, which is pretty sweeping. We'll touch on that just briefly in a second. That's really part of our previous presentation. But gifting right now is, we have this ability, if you go all the way through, you really use everything. So we're talking about, if you're in a place where you're above, 3 million / 6 million, this is where this conversation comes in. And the idea is that you can gift away everything and go all the way down, use your full exemption. There is no clawback on that. And use the full exemption to get all your, assets, quote, outside the estate. Now, to what you said earlier, Mr. Coomer, there's a lot of things that come into play with that. How do I still access the funds? What are the ways that I can, is this in line with what I really want to transpire for my kids? My kids aren't old enough yet. Oh, well, I've got this one that I don't think is responsible enough. So really putting all that into the documents is really a big deal. And so the question becomes, is now the time to act? We're above this 5 million. We're above the, this 510. You're getting on up there. And the reason why we're asking this question, and we'll come back to this slide maybe in a second, but go ahead and advance to the next slide, Ben. And I'm gonna brush through this super fast, and then we're gonna get into some other some stuff. And just go ahead and advance all these points. Thanks, Ben. So we are talking about in the future potentially higher income and estate tax rates. Now, at this point, the reality is, based off the Georgia results, it would take Georgia. Both seats would have to flip to the Democrats for most of this stuff to transpire, most likely. But the reason why this is a big conversation that's out there is all of these factors, if you read through these, completely change the landscape for estate tax and basically raise up the, raise up these, if you do away with step up in basis, all these fundamental things. And so it becomes a really important, and some of our higher net worth clients are acting now to go ahead and use up the exemption and be thinking about this. So let's back up one more slide. Thanks, Ben. Sorry, that slide's built out with the individual points, which doesn't do well. And so with that, and Mr. Coomer, so why is now kind of maybe a time to act, and when would it make sense to do something before the end of the year?
So again, CJ, if Congress were to pass a new act, and it could be retroactive to January 1, the limit could go down to around 5 million. It's going to be adjusted with inflation. They're saying it would possibly go back to where it would have been before the TCJA. So the 5 million, it was going to grow to about 6 to 7 million by 2026. So we would be somewhere in that 5.5 million range. So anyone that thinks their estate is going to be over $11 million, it would be, or even potentially they could go down to 3.5 million, which for a couple would be 7 million. If anyone thinks that their estate would be at that rate when the second spouse passes away, this would be a good time to do some planning. The planning, it is irrevocable, which is a scary word, I know, to a lot of people. But again, as CJ was referring to, we can build some parameters inside the documents that create some side doors and some back doors where we do still have the ability sometimes to take away the things that were going to cause us a problem. If we build, if your estate planning attorneys build the documents with some of those additional parameters. But again, the timing relates to the fact that the exemption amount of over 23 million could drop down to 10 million or 7 million by next year. And
And I think-
importantly,
Yeah,
as
for
the
joint.
slide notes, the regulations state that if you give the amount now up to the 23 million, there will be no clawback. So even if when you pass away, the exemption is now at 5 million or 3.5 million, the fact that you gave away the 23 million prior to death does not subject you to these lower rates. If you complete the gift, then that gift is a final gift and will not be pulled back into your estate.
And Ann, as you mentioned earlier, quite often people are put off or will delay because of the use of the word irrevocable. And I think your point is well made. I think you said you can build some side rails to protect for protection. So sometimes irrevocable is not as irrevocable as it sounds. I never forget many years ago, first time someone came in the office and said, "Hey, I got this thing, this trust and so forth. And I don't like the way my daughter's acting, so I want to change this trust." And I remember saying, "What is it about the word irrevocable that you don't understand?" Well, maybe it's not quite that restrictive any longer. So I know you and I both have been through a couple of situations where trust have been decanted as it can be done now somewhat. So there's always, maybe there's never an absolute no. And you were commenting on that earlier.
Yeah, that's a great point, Mr. Coomer. I mean, the reality is in order to get something outside of your estate or complete a gift, it really does have to be out of your control. There's lots of rules around that. But Ben, go ahead and advance to the best ways to use your exemption. You know, even though as you do that, there are some really creative ways, though, to be able to have some safeguards that are put in place to allow some limited access. So we'll talk about a couple of those in a little bit. And so it isn't a completed, you know, it has to be a completed gift for estate tax purposes, but there can still be some ways to be able to potentially access those funds in a worst case scenario, the best of which is really a SLAT if you're in a dual spouse situation. And we'll talk about that in a minute. But so as we're talking about this background, you know, if you're going to be making gifts, and this really is in play, whether, you know, you're expecting the estate tax to go back, we know it's going back eventually. There's some great ideas in here that really are best ways to use your exemption no matter what, but especially in light of changing of the exemption amount in a potential resetting or a backing down to whether it be the 5 million automatic reset that's going to happen in 2026 barring action, or in a repeal of the TCJA going to that beforehand, or in a complete overhaul of the state tax in some way, shape, form, or fashion, which doesn't look super likely right now. But if on January the 5th, those two seats in the Senate go to the Democrats, then the Democratic plan, the Biden plan, would be sweeping, and you could expect a lot of that to go through. So that's really why we're talking about this now. So let's talk about best ways to use the exemption. Mr. Coomer, you want to lead us off on outright gifts versus in trust?
Well, yes, just a brief comment on that. We can spend a lot of time on that, but maybe a brief comment. An outright gift, of course, is an outright gift and it is gone. And the donor or giver loses control, absolutely. At least if we make the gift in trust, we've got several things. We can at least, in some cases, and this is Ann's area more, we can protect the ultimate beneficiary from the beneficiary's own self at times. We have the right to attempt to make sure that our intents are carried out with respect to that ultimate beneficiary. Asset protection, protection from lawsuits, and such. So often the trust is probably the better way to go. And also that also gives the donor or the trustor some opportunities to do some things to protect some gains by replacing property and so forth. And Ann, you may want to jump in there and sophisticate that answer a little bit more, but also if I may jump down one caption, and for all of those who were listening, we had a fireside chat between the three of us last month. And we were talking about discounts and how that affects the value of closely held business and so forth. And they kept nagging at me. There's one more major factor for discounting that at the time wouldn't come to mind, and it has nagged at me. And you'll all remember this. It's very, very rare. In addition to the discount for lack of marketability, which we can talk about, or discount for lack of control, those two things that we all walk around knowing about, this would apply. The one I couldn't come back up with is based on a case called the Jenke case. And what it is where there was a potential for a large tax on built-in gain. And there are a couple of cases out there now that say that in addition to the normal discounting factors, such as lack of marketability and lack of control, if there is a significant tax on built-in gain, that must be taken into consideration and deducted dollar for dollar from the value in connection with these other discounting factors. So what's that going to apply to? A C Corp that's become an S Corporation that has substantial built-in gain, an investment firm where there's significant appreciation and significant assets. You know, I'm not going to run across that every day, but it's there. Who knows?
So
Great point, Mr.
what's interesting about this point, CJ, as we've alluded to a lot, we feel like we're in what we call the conundrum, which is up until we have the change in the exemption, we have been advising our clients that you don't want to do gifts during life if you have enough exemption to protect the fair market value of your assets at your death. The reason for that is currently, if you leave assets to your beneficiaries at death, the beneficiary takes a new basis. They don't take your carryover basis. They get the step up in basis, which is the fair market value on the date that you passed away. So for a lot of our clients, we were recommending don't make gifts during life because unless you're expecting to have significant appreciation between now and your death, or if you are already over the exemption amount, which is where we would want to be using these discounts. But if you're under the exemption amount, then you're better off holding your assets and leaving your full estate to your beneficiaries at your death. They then take the assets at fair market value on your date of death. They can turn around and liquidate it within, you know, a month or 6 months or the next year and have very little capital gain. So that has been the structure that we've been working on for all of our planning under this new regime. Now with the Biden plan, he's talking about taking away potentially the step up in basis. And what's interesting about this is it's not only, it doesn't trigger the gain just when the beneficiary sells it. What I'm reading is that his plan would say the gain is triggered at either the gift date or the date of death. And the tax becomes due at the time the asset's transferred, even if the asset's not sold. So that really puts us back into the old dilemma we used to have, which is how do we get the liquidity to pay our estate tax? We're anticipating is life insurance is going to become much more valuable to many people with a larger estate, even if you don't think you're going to need it for liquidity. I mean, previously we didn't need it for liquidity until we sold the assets, but now we may need it if we have a family business, family farm, etc., where we're not planning on disposing of the asset when it passes to the next generation.
Yeah, and that change on the step up in basis is just such an incredibly significant conversation. And this has happened before. There was during the Obama administration, there was a real push to do away with the step up in basis that got close. And I think, Mr. Coomer, there was actually a year when Biden was in office when the step up in basis did go away.
Well, it was the year 1976 when we had carryover basis. And by the way, the lifetime exemption was $60,000 or $70,000 too. But we did away with the carryover basis. But it was so complex that finally Congress just backed up and did away with it retroactively. And it sounds simple enough to say, well, we have carryover basis. But if you remember the 2010 thing, the significant rules related to calculating the carryover basis were more complex than anything else we dealt with.
That's right.
It's just complicated.
That's right. You know, and I think it's important to understand too, when we talk about carryover basis versus step up in basis, whenever you make a gift, whether it's in trust or it's outright, et cetera, the basis in the hands of the receiver is the basis that was in the hands of the donor prior to the gift. So if you have Apple stock that you bought, you know, at $10,000 and today it's worth, you know, $2 million, you know, that's not the gift that you generally want to give because you've got such a low basis in it. That's the type of gift you want to give to a charity because you can deduct the fair market value. There's a lot of rules around that. talk to your tax advisor. Generally speaking, but let's say that is a gift that you need to use. What we have out there are what's called swap powers, potentially that are built into some of the trust documents, et cetera, that allow one to swap that asset out with something that has a higher basis, like maybe that piece of land that I bought for $2 million that's still worth 2.1, 2.2. You know, because when you gift something, you move it outside of the estate, you're trading basis. You know, that step up in basis is not on the table anymore, and you're moving it outside of the estate, but the basis in the hands of the receiver is the other. So back that up one more. I know we're running a little low on time. We're going to go over about 5 minutes on this one, make up 2 minutes since the last piece. And so really important to understand a gift not really being a gift, because that is the biggest piece that most clients struggle with when you say, hey, you have $30 million and we're going to tell you right now maybe is a good time to go ahead and gift $23 million, use the full exemption, et cetera, because you get that asset out of the estate. Use the example of the Apple stock we talked about earlier. This is an appreciating asset. It's continuing to go up. And so when you complete the gift, let's just say that you had gifted that Apple stock when you bought it at $10,000. That difference between $10,000 and $2 million, that growth, if you gift it at that earlier time, is all outside the estate, therefore not subject to estate and gift tax. This is why it's a big deal for us to either gift discounted assets and also highly appreciating assets. And so when we do that, if we can put it inside of a structure like a spousal limited access trust, the SLAT right there at the top, and SLATs are really nice plays in this scenario, because it still allows one to get at the assets. Can you tell us just a little bit about how a SLAT works? Because I think that is probably the most unique opportunity we have as a option today on the table.
Agreed, CJ. So it is an irrevocable gift. It goes into a trust. If you create certain parameters over when disbursements can be made, the spouse could actually be the trustee, although a lot of times people prefer to use a corporate fiduciary. You can create, put in a trust protector, which allows the trustee to be replaced by someone else. That can be a trusted advisor that maybe doesn't want to serve as trustee, but still is available to step in if they see things going sideways, which of course is really important because again, it's an irrevocable gift. But what's really nice about this is the spouse has access to the assets primarily for health, education, support, and maintenance, which really covers your living expenses for the rest of your spouse's life. So as long as you're living, you can also benefit tangentially from the assets that are used for your spouse. And so then if your spouse outlives you, those assets continue to be available for your spouse. And then at your spouse's death, there are provisions in there to go to your children. The obvious question is what happens if your spouse doesn't outlive you? And so again, that's where we either want to have separate independent assets that are retained by the donor, or we would want to have some life insurance on the spouse's life, vice versa, have some life insurance trusts available so that if the spouse that is now the beneficiary of the SLAT predeceases the donor still can have access to life insurance proceeds for the remainder of their life. Next one is very similar. This would be for someone that doesn't have a spouse. It's a beneficiary designated income trust, kind of the same idea. You get someone like a parent or a sibling to seed the trust, and then the beneficiary actually can, other people can donate assets. So the beneficiary can donate assets to this trust, and then they can be the beneficiary as long as they're not the trustee and it's an irrevocable gift. Again, you want things like trust protector to be able to step in and replace the trustee, or ultimately if everything just goes sideways to actually terminate the trust. So that trust protector kind of steps into the shoes of the person that contributed the assets to retain some protection for the donor, since again, it is irrevocable. But both of these tools work really well, get the assets out of the estate.
And how important is
That's
it
great.
for you to have the trust protector? I heard the definition of a trust protector, which I think is very appropriate. The trust protector's role is protect the beneficiaries from the trustee. So how independent, where do we find that independent trust protector? It's kind of a new role, I think.
It is a new role. It actually started with the offshore trust trend that happened, and then a lot of states realized we just need to bring this onshore and create a lot of protections around it. It is complex, Don. more than we can talk about today, but it's something that you would want to talk about closely with your advisor on what the trust protector can and cannot do. And another interesting piece is on some of these, you keep it as what's called a grantor trust, which means that it's actually taxed to the donor or whoever contributed the assets. It's kind of another way to get a little bit more assets out of your estate because you're paying the tax, even if you're not receiving the access to the assets. So a lot of different tools we can build into these trusts to both protect the donor, protect the beneficiaries, create some backdoors where you can still have access to these funds or potentially even get rid of the trust totally. So again, unique opportunity, probably something, if you're in this, you know, $10 to $50 million or up range, it's a good time to be talking to your advisors about some planning.
That's right, Ann, you know, and just kind of in summary, thank you guys so much. And we have, as previously mentioned, the fireside chat, which gives a lot of background. You need to go back and check this out. But candidly, this area is extremely complex. And, you know, we love playing in this space and coming up with ideas that integrate the estate and gift tax planning with the income tax planning. As Ann just mentioned, you know, using intentionally defective grantor trusts, other things that are treated as grantor trusts, so that we can spin down the estate while we're growing these assets that have been out here. Because if you give something away in trust and the trust pays the tax on it, well, every year, you know, somewhere between 20 and 40% of that trust's principal is getting eaten up. Well, if I have a taxable estate still remaining over here on my side, I need to make sure that's where the expenditures are transpiring to pay up that taxes and spin down the estate with that as income tax. So this is what we do really well. These are complicated things, you know, but it is important. One last plug here is right now the AFRs, the applicable federal rates, are about the lowest they've ever been. I just structured a deal last week using some AFRs. And I mean, the opportunity to do what's called a GRAD, a grantor retained annuity trust, to do these charitable remainder trusts that are out there. I mean, it is, because the interest rates are all so incredibly low, especially the short term, we're talking about, you know, way below 1%. Even the long-term rates are around 1% and some change. I do a 9-year note with somebody at, you know, fractionals of an interest. It's just amazing the opportunities, and what all those AFRs do is allow us to move things outside of the estate without getting into details because they're somewhat complex at very favorable terms. And so that's really important, coming back to those appreciated assets, et cetera. So just be aware, these are plays that are out there. You know, if you're in this spot, you need to call us, start having some estate planning conversations. Our job is to kind of quarterback work with the attorneys to work on the drafting of the documents, but to integrate the tax planning into those documents in all the ways that Ann does a great job of working on actual drafting. And Mr. Coomer, who's spent more than 2 years, as we said earlier, helping attorneys draft these in an income tax as well as estate and gift tax efficient manner. So look at your documents. They very well, if they haven't been updated in the last several years, they probably don't work. They need to be updated, right, Ann? Super important. And with that, some closing thoughts, Mr. Coomer. Ann?
It's just time to act. We don't know what's coming. It is time to act.
And just to echo what CJ said, a lot of the documents may actually do the inverse of what you wanted to do because of the way the old rules worked. And so it's really important to kind of try to read through the legal jargon and understand exactly how they're working and be sure that's the way you still want them to function when you pass away and pass your assets on.
That's a huge point, Ann. And the reality is that sometimes, you know, and people change, you know, people, you know, and so those documents need to be updated when they can be, and or decanted or adjusted accordingly. So thank you both so much for your great experience and wisdom. So much to cover. I mean, literally, we could spend all day talking about estate and gift. Actually, I've gone to 3 and 4 day seminars on estate and gift tax planning. We're trying to jam it in 25 to 30 minutes, which is impossible. So thank you, Ann. Thank you, Mr. Coomer. You guys are wonderful. Appreciate your time today.
Glad to be here. Thanks, CJ.
So with that, we're going to move on to the individual hygiene pyramid. I'm super excited to have Rachel Lloyd and Scott Feltz, 2 great team members that have wonderful books of business they take care of at our firm and specialize not only in individual work, but the related businesses as well. So this is super fun. We've been talking about the individual hygiene pyramid for a little while. So we've come up with a fun presentation in a new format that digs a little bit deeper. We've added some extra content here on what I refer to as the tax hygiene pyramid. So as usual, Circular 230 disclosure, don't rely on this as tax advice and talk to your CPA before you go. And with that, we're going to just dig right into it, and let's launch that Prezi. So welcome, Scott and Rachel. Can I hear your voice out there?
Yep, I'm here.
Hey, Rachel, great to see you. Welcome. What a wonderful pleasure it is to have you today to speak to really just an amazing program. And Scott, are you out there?
I am.
There you are, Scott. Excellent. Well, thank you so much. Well, guys, I'm going to let y'all take it away. I'm going to do my best not to talk. We're still going to give this a full 30 minutes, so we'll finish at 12:10. And it's going to be impossible for me not to add color because this is kind of my baby. You're smiling at me, guys. You could say some other things, I'm sure, as well. But this is exciting. You know, what a great way to wrap up today with, I mean, when we can integrate these concepts in with our clients, I mean, what I love the most about it, I mean, it just changes the trajectory for, you know, we just finished talking about kind of the uber wealthy, super high net worth, you know, 20, 30, 40, $50 million type thing, where I think the individual tax hygiene pyramid, that's just a kind of icing on the cake for those super high net worth individuals. But for folks with, you know, between $1 million and $3 and $5 and $10 million type of states, you know, this is the type of planning that if we can integrate in, literally accumulates to millions of dollars. I mean, it is spectacular. So I'm going to hand over and let you guys start rolling, and I'll try and just take a color commentary backseat here. So welcome. Thank you. Proceed.
All right, thanks, CJ. And so Scott and myself will be doing this presentation. So we have the hygiene pyramid, and we want to work from the bottom to go to the top. So the first step of this is 401k. So we always want to make sure we're funding our retirement. It's really good, but it's even better to do it with free money. So we can't say no to free money. So make sure you always take advantage of this option, as CJ would say. Make sure you qualify up to the match, at least to that point. You don't need to, you can pause at that period. You don't need to contribute more because we're going to take advantage of some other options. The contributions you make to your 401k are exempt from both Social Security and Medicare, and the account will continue to grow tax-free. So you don't have to worry about that until later. Okay, we'll go to the next one. And that's going to be the Health Savings Account, or HSA. So in order to take advantage of the HSA, you have to have a high deductible health plan. So that's one of the requirements you have to have. For 2020, and these are indexed every year for inflation, if you have a family plan, you can deduct up to $7,100 or $3,600 if you're single, and receive a tax deduction for that contribution. If you're 55 and over, you're allowed a catch-up contribution of $1,000. You do have the opportunity to invest the account in a brokerage account and continue to grow the account even higher, income tax-free. So in order to withdraw the money, in order to avoid any penalties, it has to be used for qualified medical expenses. So that includes both the contribution side and the growth of the brokerage account. If you reach 65 and you have no medical need for that HSA, you can then withdraw the account and avoid the penalty. You do pay tax, but you can avoid the penalty, and it treats it just like any other traditional IRA or 401k. If you're under 65 and don't have that medical need, there is a 20% withdrawal penalty, and you do have to pay tax on the amount, unfortunately.
That's right, Rachel. You know, and I call this the fund it, don't use it strategy. So if you're in this world and you're able to fund it and don't use it, this becomes a whole nother bucket of income, because you get the deduction, it grows income tax free. And then when you take it out for medical expenses in retirement, you don't pay income on it at all at that point. And so statistically speaking, you're going to have medical expenses in retirement. So this is even better than a Roth IRA. We joke around and kind of call it a Roth IRA on steroids. Because if you're eligible to do this, and I mean, there's just no reason not to take advantage of fully funding, let it grow. Don't use that, because right now you're in the highest income tax brackets anyway, most likely, or getting on up there. You're in your highest income years, and then wait till you're older. Take it out for medical expenses. Worst case scenario, you have a super healthy retirement. Then you just take it out like a regular IRA and pay income taxes on it then. And so this healthy, the reason why this is number 2 after take the free money is because it really is pretty spectacular, isn't it, Rachel?
Mm-hmm. Okay, Scott, I'll turn it over to you.
Yeah, thanks, Rachel. And so Rachel, kind of hit on two elements that you have to meet certain qualifications. Either you have to be an employee where there is an employer match available, or you have to be in a high deductible plan. But then moving into the Roth or non-deductible IRAs, this is an area where everyone can participate. Everyone's eligible. Now there's some income limits to going direct to the Roth, and we can hit that, but there's also some ways around that. But really the beauty of the Roth is it grows tax-free and you take it out tax-free. You do not get a current year deduction. So this is not a way to reduce that current year tax. However, the upside potential we feel like is just so much greater. You're not paying tax down at the end of the line when you start pulling this out, which is unlike a traditional IRA. You can always take your contributions back out. There's no time limit on that because really you think about it, this is money that you already paid tax on. You put that in, you can pull it out. But there is a 5-year rule in effect where that money has to at least have been in the IRA for 5 years before you can start taking those tax-free distributions at age 59.5. So if you don't start funding this until age 59, you can't start taking those tax-free distributions at 59.5. You'd have to wait till 55. It has to sit in there for at least 5 years before you start taking it out. And there's no age limit to contributing to a Roth now, which that is a really cool thing that's happened recently. I believe that was through the Secure Act even. And so direct contribution to a Roth every year, you can contribute. Well, for the 2020, you can contribute $6,000 per person, and so that can be for you and for your spouse. And there is an option for to still contribute to a non-working spouse account, and so that $6,000 can be 12, and then if you're over age 50, there's a $1,000 catch-up. So then that 12 can be 14. Again, mentioned a minute ago, there's some wage limitations on doing a direct to Roth contribution, but there's a back door. So when the front door is closed, let's find the back door. And in this case, we can contribute to a non-deductible IRA, traditional IRA, and then just roll that into a Roth. And basically, we've done. We've had to take an extra step, but it's a loophole in Congress. It's been there for quite a while. We think eventually they'll close it, but they just never have. And so, take advantage while it's still there.
That's right, Scott. One of the things to be aware of as we're working through that is just to make sure that, there's some really specific rules about aggregation of IRA accounts. And so this really only works from the backdoor conversion strategy if we're intentional on the front end to make sure there aren't other IRA funds out there. Otherwise, you have the pro rata rule that comes into play that could result in taxation. So you got to be careful about that. But otherwise, the idea is you get basis in there, do the flip, you have complete basis in the flip to the Roth. And then now you're basically, and really what Roths come down to here is you're taking money that you don't get a deduction for, but it's growing income tax free, and it comes out with no income tax, which is really quite spectacular. And so we want to get money into that Roth whenever possible. And great job, Scott, kind of talking about all the different rules. You do have to have taxable income, earned income, wages, or subject to self-employment to the degree that you do a contribution. But one of the best things with this Roth, if you got a kid out there that is, got that job at the Chick-fil-A down the street and they're earning, a couple $1,000 a year, this is one of the best things you could do for them is go ahead and set up a Roth. Maybe you don't tell them about it and put the money in there to the degree that they have wages. It's really, really exciting, and it can create just an amazing nest egg long term. So thanks, Scott.
Yeah, absolutely. And, kind of piggybacking off of what CJ said there, we did this version of this talk last year and included some charts on, what the time value of money effect of, that, 15, 16-year-old kid putting into a Roth, and, the upside potential of that growth is insane. It really is cool. One of the other things just to mention, there are no RMDs for a Roth during the lifetime of the account holder. There were some changes in the Secure Act that, just to highlight, there's the new 10-year rule. And so for traditional IRAs, you do have to start, or for beneficiaries, you have to empty those funds within 10 years. We used to be able to stretch those out over the lifetime of the beneficiary. That does not apply to a spouse beneficiary. However, it will apply to others with some other caveats for like minor children, disabilities. But those are things to take into consideration when talking about conversions. Again, we look at 2020 might have been a bad year. And is this the year to look at maybe converting some traditional funds to Roth funds? And then, we get the upside benefit of the no RMDs during your lifetime, and then some more favorable benefits to the beneficiaries where they're not going to be taxed on the growth of those RMDs when they do have to take them. So then we're going to move to the next step in the pyramid. We're going to talk about maximizing our deferrals and our contributions. So really this is, Rachel talked about, contribute up to the employer match and then pause. And then, we work through the next steps of the pyramid, and here we are back. And we're going to look at if this is your, maybe this is the next best opportunity is to then fully fund that employee 401k. We're looking at putting as many dollars as we can into tax favored accounts. If your employer has a Roth 401k, that could be even better. Now you're getting the benefit of being able to put more than just that $6,000 in the Roth funds. You could go up to, 19.5, if we're talking about 2020, if your employer offers a Roth 401k plan. You want to consider benefits of a Roth deferral versus traditional. So if you're in a really high tax bracket this year, maybe the traditional is a better option. Maybe you're better off to reduce, if you're in the highest bracket, 37%, then you could be saving, 37 cents on every dollar you're putting into those traditional funds. A lot of times that's going to be more age related. If you're younger, then time value of money, that 37 cents, you're going to earn that back and then a whole lot more over the course of time. If you're, further along in life, then, that might be the conversation where we walk it out and say, is this better to go Roth? Is this better to go traditional? And then self-employed, there's even different options. Self-employed, there is a solo 401k, or basically just a 401k for self-employed. It operates very similar to any other company 401k with the same dollar limits. There's a simple IRA. In that case, you can contribute up to $13,000 as an employee. The employer can match that dollar for dollar. So if you're self-employed, that could be $26,000 in total put into the simple funds. But a SEP could be the ultimate option. If you've got a higher bottom line at the end of the year, you can get up to $57,000. Now, some rules around that is it has to be up to or 25% of net income. And so this is where we look at, are you doing more than maybe 120,000 a year in net income to make it worthwhile considering the SEP over the 401k. However, I put a couple of clients every year into a SEP because we're able to open and fund those accounts after the tax year is closed. Whereas if you're considering a 401k or a simple, those are things that have to be established this year if you want to be able to contribute to them even into next year. They still have to be set up in advance. I'm going to throw it back to Rachel.
Okay, thanks, Scott. So our next one that we're going to talk about is the cash balance defined benefit plan. So this is very similar to the pension plans that were all the rage in the past that don't really exist anymore. So this is the next best thing. We use a third-party actuarial computation. This is something that we don't do personally here, but we work with third parties. They determine the life expectancy, the benefit amount, the present value of the contribution, and that's where you arrive at the defined benefit. So this has to be in force for at least 5 years, usually between 5 and 7 years. Eventually, you can liquidate the plan and then roll it into an IRA, and then you have the normal IRA distribution rules that we've already talked about. All of this is efficiency ratio contingent, so it's important to look at that. Employers may end up contributing more to the employees' plans than other retirement plans, so something to look at there as well. So I think
That's a
we'll
great
go ahead
point,
and go to the
Rachel.
next
You know,
one.
these. Oh,
Go ahead.
sorry. No, you're fine. So, you know, one thing that's really nice to think about with these cash balance defined benefit plans, earlier we talked about the trifecta. This gets layered generally on top of what's called a safe harbor 401k plan. And so when the actuaries, the TPA, the third party actuary, who literally it's the TPA, but the actuary actually is a side person. They're kind of, you know, I love the old accountant joke. How can you tell the difference between an actuary and an accountant? Well, an accountant looks at your shoes, which is to say the actuary is looking at their own, you know. So there's not many folks much more boring than us accountant folk, but the actuaries run the numbers and are able to then determine how we can get that efficiency ratio just right. And so ideally, this works really well when you have not a ton of employees, or there, you know, you could still have 40 or 50 employees, but there's a big age discrepancy and compensation discrepancy between the owners and the employees. And so when those factors are in place, I mean, if you know, especially if you're making $500,000, $600,000, $700,000 a year, all you have are independent contractors, or very few employees that are in their 20s, you're 55. I mean, these things are great. You know, I have a client that we had about 30 employees, 25, 30. We just finished wrapping 7 years in. We put $3.5 million away at a 96, 97% efficiency ratio, which is to say 97% of every dollar, that 3.5 million, went into accounts that were for the benefit of them or the owners or their kids. And so, I mean, it's just amazing to see this play at work. And when it works, man, it works. But again, this is high up the pyramid. We've already done, you know, free money. We've done the HSA fund it, don't use it strategy. We've completed Roth conversions. We've completed backdoor Roth conversions. We got our Roth contributions. We've now filled up our regular deferrals, you know, be they Roth or traditional. So this is working our way up the pyramid. But once you get to this, when you see this play out, these are big numbers. You know, we're talking about 150, 200,000, 300,000 per person that can be maxed out. And so, you know, just to kind of give you some perspective on that. But my goodness, when it works, you know, we would be remiss if we didn't talk about this. This is a big deal, isn't it, Rachel?
Mm-hmm. It is. Okay, and then the next one we're going to talk about is Section 529 plans. So these are also referred to as cafeteria plans, if you've heard of those before. This is where we're going to take care of our kids and our dependents, because we're taking care of ourselves first, then let's focus on the kids. So a Section 529 plan allows for a contribution of up to $15,000 per year per beneficiary. You can contribute up to 5 years at once and take advantage of that. It does count toward the annual gift exclusion, which is $15,000 for this year. The maximum contribution limit for the entire account is set by the state. So depending on which state you set up your 529 plan with, they have different rules on how high that can be. You don't get a tax deduction for it, but like most of these, it grows tax-free. So the tax distributions, when you want to withdraw the money, they are allowed for qualified educational expenses. This includes all the way through elementary education, through college. It can be for private schools. The expenses are tuition, fees, room and board, computer costs, any supplies that the student is required to have for classes. And with the Secure Act, this was something interesting. If you have money left over in your 529 plan, which as far as college costs nowadays, probably unlikely. However, if you do, they allow for $10,000 of your 529 to pay down your student loans. So that's a good option too, if you still have some of that money laying around. You do have the ability to roll the account to a new beneficiary each year with 1 degree of separation. So within a 12-month period. So think of your siblings, think of cousins, or your parent wants to go back to school, or your niece, your nephew, or something like that. Let's see, what else? There is a scholarship option. So if the beneficiary does really good and gets a scholarship, they're not penalized for earning that scholarship. They can withdraw the amount of that scholarship penalty free. So then they can use that money on living expenses. So whatever they need to do for school, it can be used as somewhat of a stipend, so they don't have to work while they're in school. So that's a good option. For non-qualified distributions, you're starting to see a theme here. There's qualified and not qualified. So not qualified distributions, there is a penalty. It's 10% of that withdrawal. You can also end up rolling into an ABLE account. So say your beneficiary becomes disabled, they're not going to attend college or anything like that, they need an ABLE account. There is that option now where it can be rolled directly in with no penalty. Also, part of the cafeteria plan is a dependent care FSA. So with all FSAs, it's either use it or lose it. So keep that in mind. You can't roll this each year. You're allowed up to $5,000 tax-free to go into an account to then pay for your dependents, daycare, nannies, summer camps, things of that nature. So it's a really good tax-free option because you're going to have to pay that expense anyway. So something to think about.
That's right. It doesn't get a room to itself. It gets put in the same room with the 529 plans. But those FSAs are nice, and so you used to be able to really load those up, change the rules a little bit around FSAs to limit that, but still $5,000 to be able to get the income tax deduction, push that to the care of the child, really nice. And then of course you still got the rules for the medical expenses as well. So take advantage of those FSAs. They're out there, not a ton of juice, but a little bit. So.
Yep. All right, Scott, I'll turn it back over to you.
Yep. So now kind of walking up the pyramid, now we've done all these other things. We've, got, tons of money parked in tax preferential retirement accounts, our 529s or, HSAs, 401ks, Roth IRAs. Now we still have some money. We're trying to figure out what do we want to do with this? How do we want to let this work for our benefit? What about real estate? Real estate is a great next option for having, some money into a very what's traditionally a very stable investment. And if, you're in the Nashville area, which, that's our client base for the most part. So I'm assuming you are, that real estate is a really good investment in this area, or certainly has been in the last 10 years. It's crazy. The price of dirt has, just exploded. And sometimes people want the house that's attached to the dirt, but mostly they're just wanting the dirt right now. And so, this is a great way to defer some growth, put some money into real estate now, let it grow. Obviously we know that, it's not as liquid. If we want to get that out, we're going to have to sell it down the road. But it's a great way to let that appreciate tax-free. If we're going to rent it out, then, we need to look at passive activity rules. If you're, if this is not what you do for a living, if you're not a real estate professional, then there are some limits to what you can actually take in losses. But if you've got other investments out there that are having passive gains and the real estate is losing, then, that's a way to match those up. Or if you've got investments that, are doing poorly, but your real estate's doing great, you've got, renters in there and it's killing it, then there's a way to offset, some of those gains with those investment losses. And so, we've got to look at, the passive activity piece of that. But if you are a real estate professional, if this can be an active investment, then cost segregation is something that we've been looking at. It's really taken off recently and been an incredibly beneficial opportunity for a number of our clients and friends to be able to look at these assets that traditionally would have been depreciated over 27, 29 years, and taking them out and being able to take full 179 depreciation. And so there's some benefits potentially in cost segregation studies. And so that's something we can talk about with you to figure out, would that be to your benefit? But with that, we look at, again, some of these bewares, 1250 recapture. And so, if we've, done this cost segregation and took the benefit of accelerated depreciation, but maybe you were in a lower tax bracket that year and we're only paying, or only realizing about a 15, 20% savings, and you sell that property and have to pay that recapture at 25%, then we didn't really do a win. And so this is where, again, we have to look at all the pieces in play. And these are the things that, we're aware of and want to bake into those conversations and make sure, not only, could cost segregation be a good thing, maybe it's not the right thing for you in your environment. And so, this is, the overall conversation of, what is your ultimate goal and ultimate plan with this? 1031
that's a
exchange.
great point, Scott. Sorry, I was going to just add in there, your play. Sorry for interrupting here, but really important to understand, real estate cost segregation rules. Really the play there is to take advantage of bonus depreciation, and so in essence, you're able to get a shorter life, which then gets you into the bonus depreciation category instead of 39 or 27.5-year life. And generally speaking, most likely not eligible for 179 for most of this real estate stuff because it has to be active trader business, but are going to still be able to get bonus, which effectively gets you to the same place. That recapture is nice if you've had the depreciation and you've sheltered, and this is really the thought on the bewares there. But if you've been able to shelter income that you were going to be paying, 37, 3.8% surtax on there, so 40.8% plus state level taxes generally a lot of this. So you're talking about 45, in some states 50%. To turn around and pay tax at that recapture rate of 25, especially if we can do some flipping and find ourselves in a spot where we're not subject to the income tax in the state level, paying that 25% versus getting that benefit at 50%, super great. Scott, great point though. If you're in the lower income tax brackets, you could find yourself flipping and getting the other side of that coin. But generally speaking, keep in mind, we're made our way up the pyramid. And so it's important to understand that most of our clients are going to be, at this point, you've gotten all the way to the top, right? And so you're going to be in a higher income tax bracket. So you're getting these benefits, you're sheltering income. And then when you sell the underlying asset or defer it with 1031, get a step up in basis, never pay tax on it, ever. And so this is really, real estate investing is really phenomenal, not only from the growth perspective, the tax deferral, they got a great lobbyist in Congress, but then also the ROI. If you use leverage, be careful, right? Scott Phelps, there's some, Dave Ramsey fans out there, be careful. He has some things to say about real estate investing with leverage, but if you do the math on it, you can get, 30 and 40% returns on investment in the early years. As time goes on, the way ROI works, it doesn't transpire as much. So, real estate investing is huge, guys. You really need to take advantage of this if you're at this point of the pyramid. So we've got, I think, 2 left from here. Yep. So we got just some other tax deferreds, and again, now we're really getting into some very specialized, some very unique situations. Again, we've walked our way a long way up the pyramid. Annuities. This is something that, I think we've all heard the word, may not necessarily, know, the newest, the slide says, not your grandmother's annuities. A more recent advent is the longevity annuities or the delayed income annuity, where, you're paying in now and not necessarily turn around and getting those payments back right away, but allowing some time to pass before those come in. If an annuity is something you're looking at, then the benefits can be great, the returns are great. However, you're basically saying I bet that I'm going to outlive this.
The actuaries, they're going to bet against you. But there's some really cool things in there. There's some great opportunities. And again, these are strategies for, deferring tax if you're getting to a point of, well, now what? The idea of up to MEC, so modified endowment contract, life insurance policies, again, a way to shelter some funds and get some tax advantages, these are typically based around insurance policy, whole life, universal life, so they're not, these are really not, in my perspective, you're not buying this for the insurance policy because you're paying a lot more than you would on a term policy, 5 to 7 times as much, maybe as much as 10 times more. And the commissions can be higher. So, for me, this is not an insurance policy purchase. This is, what are the other tax advantages we can get out of playing with, this insurance? And, and again, this is, we're more to the top of the tower, and these are conversations we can have, on more of a personal level. What could this look like for you? And if you're not happy with an insurance policy, there's some really, favorable rules around this 1035 exchange where you can essentially exchange one insurance policy that may not be working for you for one. And this is a very light kind. The rules are favorable, but they're also very restrictive. And so, you can't really move from an annuity to a whole life policy, or, things that, move you too far away from what you already have. But if the policy you have is not, necessarily working the way you want, then this is something we can look at to help you say, well, can we find you one that works better? Can we find one that, fits your needs? It's worth hanging on to this because you've had it forever and you've paid it all off. Great. Well, let's make sure that it's actually doing what you want it to do. But the bewares, the bewares, early cancellation fee, the fees, high commissions, restrictions, those are the things to really beware of.
It is, and so I think we got one more we've got to work on through here, but these tax deferred investments, thank you, keep us moving into deferred comp. But, the thing with insurance is, again, like the real estate folks have a great lobby. So the idea here is, as long as you're not paying great, big, huge commissions, you've already loaded up everything else in the pyramid, you find yourself able to make contributions to a life insurance policy. It's built out where it's not an expensive insurance salesman sort of deal. It's a bad deal. You have cash value that gets built up inside of it. So it grows tax-free. So you don't get a deduction, money goes in, grows tax-free. And then you can either borrow against that life insurance as that cash grows tax-free underneath the policy, or you can withdraw premiums first, very advantageous, all the way down to that growth. And so it's just another tax-efficient vehicle. So the last thing on our pyramid here is deferred compensation plans. It's at the very tippity top, but it's something that we actually do consider. And a lot of times it does make sense, especially if you're working for somebody you know is going to be around. So who's doing the deferred comps?
That's me. And like CJ said, this is an area where it ends up being a little bit more specialized. And, we really look at if this, is this worth it? And usually it depends on your tax bracket. You're going to be in the highest tax bracket, and you're looking at pushing some of that off into a future year where potentially the bracket's going to be lower. And so maybe this is a year where you got a big bonus, a big commission came through, something's happened that's exploded the income, or you're just having a good high income year. And next year, the next 2 years, 3 years, whatever that time frame is, you're going to be lower, and you can spread that out and not necessarily pay at those higher rates. The things to consider here are, again, we're assuming you're going to be in a lower tax bracket in the future than now. As we've talked about earlier today, we don't know what's going to happen with legislation. The tax brackets may not be better in the future. Maybe they hold the same, but maybe they don't. But the real bewares on this are, these are not secured claims. They're often unfunded liabilities of the company. Something happens and your company ends up insolvent. The creditors get in line and they take precedence over you. And even if your company has funded these liabilities, they're still subject to the claims of the creditors before you. So this is basically like, well, we're going out of business and we can't afford to pay you, for what you did for this last week. You're kind of in that same scenario where you deferred your compensation and now they say, well, we can't pay you for last week or what you did last year when you deferred it. I'm sorry, it's gone. And so that's really the biggest pitfall that folks can find themselves in deferred comp is it's not guaranteed if the company goes away. But again, it's a tip at the top of the pyramid and can be a very viable strategy for some of our clients and friends if the circumstances are right.
That's right. And integrating in those types of concepts with stock options, et cetera, we love doing that. It's important to get a good model out there. We do a lot of planning. We use a software called Planner CS. Chris, that was a great decision, Mr. Griffin, when we added that to the software package years ago. And my goodness, I don't know how we lived before that. So Rachel, Scott, if you don't mind, Ben, zoom us back out to the pyramid as a whole. I think it is just, wonderful job, both of you guys. That is just really, really fun to go through this. Taking full advantage of this pyramid, I am telling you, it is so meaningful. That's what here at Blankenship we love to do. Help our clients get into the pyramid and start working their way up. And, not all these rooms are going to apply to everyone, but my goodness, some of them apply to you. And for most of our clients, at least 5 or 6 apply to you. So please, build those out, take advantage of it. When you do the math on it, as Scott alluded to earlier, we're not talking about, it's an extra 100,000 and then it's 150. It's millions, especially if you can get started earlier in life. That's one of the keys. Help your kids understand the tax hygiene pyramid and help them get into that world early and then stay in it for a while. Who knows? These things all change with time, but we've got some pretty good history, decades now around most of these concepts. And so these are pretty steady things. They're rock solid, like that pyramid, that was built over in Egypt. And so take advantage of it, get into those rooms, study it. And Rachel, Scott, excellent job. Thank you so much for joining us today.
Thanks, CJ.
Yeah, thank you. Thanks for everyone for being on.
That's great. Well, that wraps up our time today. That was 6 intense 30-minute sessions to be about 15 minutes over or so. Pretty phenomenal for me, but thank you for bearing a little bit as we went over a lot of information, a lot of areas. A very special thanks to the presenters that all did a wonderful job today in helping build out this content. Ben helping us lead the process of getting all this information together and tag teaming this with me and everybody else. What a wonderful thing. And Nicole, for all your video work and getting this out on the website. That'll be out by the end of the week. Nicole, thank you as always for your help and work on that. And then of course to our team overall, these concepts would not be possible to be integrated into the client base without the team doing the work on a day-to-day basis. And then of course to you, our clients. Fundamentally, that is why we are here. We are here to serve you. And so we would love to get a phone call, talk through these issues, dig in and do some specific projections as alluded to earlier, and come up with the best strategies. Some of those can be one-year strategies, some are multiple-year strategies. But we want to thank you as our clients for giving us an opportunity to serve you. We know it's a choice you make every year, and we are grateful for it, and we do not take it lightly. So with that, I'm going to close us out today with a quick blessing, and may the Lord bless you and keep you, cause his face to shine upon you, give you peace and rest, and just blessings on every single one of you. Thank you so much. Have a wonderful day. God bless. Take care.